morning. I'm Julie Hyman alongside Brad Smith. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know, investors are ready for March after markets closed out February in a subdued fashion, to put it mildly. Bonds and equities had a setback in the month as strong data renewed rate hike fears. And this came after a euphoric January with the S&P 500 gaining just over 6%. As we kick off a new month, today we've got manufacturing data on tap from ISM and S&P Global. Any signs of resilience from these data points will give more insight on the Fed's path ahead and could determine how March will go for the markets. Second thing you need to know, retail caution persists after Walmart, Home Depot, and Target said it's going to be a tough year. Now Kohl's and Lowe's are joining in. Kohl's earnings missed estimates, posting a loss, issuing a full-year profit warning as it deals with slumping demand. As for Lowe's, it posted a beat in the fourth quarter, but did have a cautious forecast as its sales remain under pressure. Lowe's same-store sales fell 1.5%. That's a big change from just a year after the retailer benefited from a red-hot housing market. And third thing you need to know, grab your popcorn. AMC earnings are out. The theater chain beat on the top and bottom lines in the fourth quarter, but its revenue did fall more than 15%, and its losses widened compared to a year ago. That's despite big box office releases like Avatar and Black Panther. AMC is still struggling to get attendance back to pre-pandemic levels. CEO Adam Aron noted that he does not expect the industry to return to those levels until 2024 or 2025. The stock's been popular, of course, among retail traders in recent years. It's seen a lot of volatility, and it fell nearly 40% in the past 12 months. Brad?
Well, let's get a look at the Wi-Fi Interactive for a deeper dive into February's action and what to expect in March here as well. You're taking a look at the futures this morning. Actually, let's just scroll this a little bit here so we can get you that futures look. But that's where the Dow closed yesterday. It closed out on a down note for the month of February. But taking a look at the Dow futures now, down by about 0.2% here, and putting this on a chart view so you could see what that past month has been like, and ultimately one thing that we are going to continue to track over that past month and that past month's activity, the Dow, that moved lower. This is the futures, so I'm going to put this back on that broader view for you folks there. But the Dow over the past month, down 4%. The Nasdaq Composite, that moved lower by about 1.1%, even amid this rebound that we've seen in tech to begin the year. And the S&P 500, you saw that move lower by about 2.6%. So there's a few things on the spending fronts, both for consumers and households, but also for businesses to look out for this month. Particularly, you're going to get some earnings from both cloud companies and companies in the business of cushioning your feet. The sneaker companies are going to be reporting too. So it'll be interesting to see what type of spending they're tracking among both of those subsets of consumers. Yeah,
and as I mentioned, we're going to get manufacturing data today from ISM and S&P Global, which will add to the already sort of confusing, honestly, data landscape that we've gotten out thus far. Strong jobs, strong consumers, some of the other measures not as strong, inflation still rising. Can we take a look at the 10-year actually as we're taking a look at how the month has been? Because the 10-year movement has been interesting. This is yields. Wow. That means price has gone down. So just as we have seen stocks fall, people are not finding any refuge in bonds. Yes, people are buying to some degree for the yield, as the yield is going higher, but the price has been going lower. So, there's really not been that many places to hide during this month. But if you look at the heat map, I know that we have one place that there has been to hide, and that's in some of these large cap tech stocks. If you want to hit the month to date or the 1 month perhaps.
The 1 month,
Let's do the 1 month, because there you'll see a lot more green on the screen, right? Tesla up 19%, Nvidia up 19%. So that's been one of the areas perhaps that some investors have been going into, even as rate expectations rise.
Yeah, and even over the S&P 500 sector performance that we've seen, it's interesting. Energy, of course, the major story of 2022, the outperformer in that year. However, energy lagged last month. That was down by nearly 7%. While, take a look at technology. To your point, those mega cap tech stocks really putting the team on their back last month, and really the lone gainer over the course of February. We'll see if that activity persists throughout March as well.
Yes, we will. We'll be keeping an eye on that. We talked about the data we got this morning. We also got Chinese manufacturing data that came in better than estimated. That has been helping out stocks as well. Some of the ADRs that trade here in the U.S., that's the 1 month, which obviously has looked pretty lousy. You want to take a look at the pre-market for some of these guys to see how they're doing, because this is going to be an area of intense focus as well. Alibaba, for example, is up by nearly 6% this morning, and we're seeing a lot of other green pre-market trades for a lot of these Chinese companies.
Yeah, and it's also been interesting to track some of the companies that are benefiting from what's taking place in the data that's coming out of China as well. One particular company that talks a lot about their ambitions in construction in China and looking for that to grow out even more as some of that stimulus gets put into construction projects in China, Caterpillar, one of the Dow 30 components here. And so you heard them talk about that handedly on their earnings call as well.
Yeah, there is one more data point that I want to touch on, and that already came out this morning, and it has to do with mortgage rates. They're moving higher again, and applications have really slumped. Overall demand has now fallen to a 28-year low for mortgage applications. So that is obviously quite significant that we're seeing here as we look at some of the housing data that we've been watching, Brad. And we have started to see mortgage rates, the 30-year fixed, you can see it increased to 6.7%. So it's not at 7 again, but it is going back towards 7% again. And that's really been a psychologically important level. Like if you're going to get a mortgage and you're staring down the barrel of that 7%, that might give you pause about whether you're going to be making that home purchase.
What's particularly interesting, too, is the number of home buyers that had flooded into the rental market as well, one where I sit handedly in and perhaps many of our friends. And I think here in New York City, tracking this extremely closely, if there is some easing, at least in the home buying market and for buyers to potentially start to nibble at or start to put in bids again, then one huge thing that we're also going to be tracking is the number of rent prices across the U.S. kind of economy right now that start to come down as well. And that's key to seeing where, in addition, at the same time, some of the supply is coming online for new buildings. And that was one of the reports that really caught my attention earlier on this week as we kicked off the week, was the fact that because of that supply that was coming online in the rental market, you're both seeing prices come down there. And then additionally, if you do see some of the pressures, at least in the home buying market, in terms of being priced out of the market, if you see that start to abate, then perhaps as well we could see some lessening of the pressure on a core necessity and just housing spend.
Right. Yeah, exactly. In terms of consumer and what we're watching, got to talk about retailers too. They're remaining cautious as inflation weighs on consumers. Kohl's and Lowe's out with their earnings this morning. They're both aligning on the same theme of more caution ahead. Let's dive into the retail earnings and the state of the consumer with Jerome Martis, Refinitive's Director of Consumer Research. Jerome, good to see you. Speaking of retail, what a cool dress you have on. Let's talk about the caution that we're hearing, right? Because it's not just Lowe's and Kohl's this morning. We got it from Home Depot. We got it from Walmart. We got it from Target. Given that the numbers right now look pretty good for some of these companies, why so much caution? What's going to go wrong as the year goes on?
As you mentioned, Julie, good morning. Yes, it's not just Lowe's. It's also Ross. It's Target. It's a number of companies who are warning us not to expect too much from them. And this is mainly because the theme this earnings season is inflation. About 146 retailers have already reported, and over 90% have mentioned inflation during their earnings call. And they're warning us not to expect too much from them. They've been very conservative on their guidance for the first quarter. In fact, for every positive guidance we've received 7 negative guidance, pre-announcements. And this is the highest negative to positive, the weakest negative to positive ratio that we've seen in over a year now, mainly because of the uncertainty of the macroeconomic factors and where inflation might be headed for the rest of the year. As a result, earnings expectations have been lowered for the full year for 2023 and also for the first quarter.
For some of these companies, and especially for Target and Walmart, Jerome, and great to see you, it's really about the discretionary categories that they've taken a hit in. Where do you see either further pricing mechanisms that they're going to have to roll out, and that perhaps continuing to impact some of their margins just in order to clear out old inventory in the apparel, electronics, the home categories as well?
So there's different dynamics to your question, Brad. Good morning. So first off, because of the inflation, the value proposition is key to the consumer. The consumer will only open up their wallets if they feel that they're getting a good price or a good discount. So in a collaboration with Centric Price and Refinitiv discovered that the average promotion rose in the month of January, which is what helped bring in a lot of that traffic that we're seeing that retailers are telling us that they saw in the month of January. But already like companies like Urban Outfitters are giving us a glimpse of February, and we're seeing that the traffic already decreased. So number one, yes, there's going to be a lot of promotions in order to move that inventory, which we're already seeing is hurting gross profit margins. Then there's the value proposition. Consumers are trading down. And as a result, we're seeing that the dollar stores are benefiting the most. Groceries at Target and Walmart are the main sectors that are helping offset a lot of the weakness of discretionary spending. But then also we're seeing that the dollar stores knocked it out of the park today. And this is because the low-end consumer is gainfully employed. There's high demand for their employment. They feel good about their job security. And as a result, the dollar stores are expanding their stores in a time when a lot of the other retailers are struggling. As a result, the dollar stores posted some of the strongest same-store sales we've seen in even before pre-pandemic levels.
Yeah, which makes sense given what we're seeing from the consumer, although we are seeing those Dollar Tree shares slip a little bit. One company that sort of stands out here as not showing strength, despite being, one could argue, on the value end of the spectrum, is Kohl's, right? The company's same-store sales fell 6.6%. That's more than estimated. The forecast for the full year, I mean, even given that we've had a lot of negative forecasts, this one is pretty bad. $2.70 a share tops for the full year in earnings per share is what the company is expecting. Analysts are looking for $3.20. We know Kohl's, Jerome, has had some issues, right? The company's CEO left. It's under activist pressure. What do you see it doing to sort of get consumers back?
Well, in fact, it's interesting because this is a sector, we've been talking about the death of the department stores for quite some time now. It's not just Kohl's, it's more of the fact that the department stores have fallen out of favor. However, when we look deep into that sector, there is one department store that stands out of all of them. That's Dillard's. And the reason I'm bringing up Dillard's is because this is a retailer that has smashed earnings expectations and has done much better than the other ones because it's controlled its promotions. It's been less promotion during the holidays, and as a result was able to do better when it comes to margins compared to the other department stores. And also it's been able to steal some of that market share between Macy's and Nordstrom's as it's trying to maintain some of its exclusivity with better brands and hasn't suffered as much as the other ones. So in order for Kohl's, I think it's more of a department store issue. Less promotions would definitely help a lot of the profits at these stores. But in general, they've been out of favor for some time. In fact, even the mall stores. And as we're seeing, it's also a very bad macroeconomic situation right now where the consumers have shifted their spending. They're moving away from discretionary and sticking to staples. As a result, it's not the best scenario for the department stores in 2023.
And what about for stores that dabble in the business of buying in bulk? We got a company in Costco that's going to be reporting earnings this week. Is there anything that you're seeing among consumers that would say that's exactly where they're going? They're going for the 24 pack of anything from the toilet paper all the way to the paper towels at a time to really offset or at least hedge against where they might be seeing inflationary pressures elsewhere on a per unit cost.
Absolutely. I was at Costco this weekend, and let me tell you, those lines were incredible. As the consumer continues to gravitate and stick to those where value is everything for the consumer right now, they're looking for any way to save a penny. And as a result, Costco not only does well because of the value, but it really has that loyal consumer that continues to renew that membership. And because of the macroeconomic situation, since the pandemic, it has consistently continued to gain more membership. And that is key, especially in this macroeconomic climate. We're also seeing that because the value proposition is so important, that the families are telling their other family members, and as a result, they're luring in also new shoppers. So they're getting word of mouth. The value proposition is there, luring in consumers, and obviously they're in strong demand. And they're giving discounts also at the pump, which we're seeing that the retailers that are offering more discounts at the pump, like Sam's, are continuously outperforming the other discounters. So as a result, Costco is well poised to do well.
We are looking forward to those numbers. Thanks so much for talking to us, Jerome. Jerome Martis is Refinitiv Director of Consumer Research. Appreciate it.
So much for having me.
And sticking with retail, Brian Sozzi will be speaking with Abercrombie & Fitch CEO Fran Horowitz off of those earnings. That is at 11:30 a.m. You do not want to miss that. And Costco earnings are out tomorrow, and we've got you covered. We're going to give you live analysis right after the earnings call and our immediate reaction, plus the vibe checks, all the details from what the tone, the tenor is when Costco, Yahoo Finance's 2022 Company of the Year, reports earnings. And AMC shares are in the red this morning, despite reporting better than expected earnings for the fourth quarter. We will dive more into the numbers later, as CEO Adam Aron remains confident that their multi-year recovery will continue to show considerable progress this year, but does not expect the industry-wide box office to return to pre-pandemic levels until 2024 or 2025 at the earliest. We've got more on that, as mentioned, later on in the hour.
The CHIPS and Science Act officially kicked off yesterday. Applications now open, and companies are now able to apply for the grant to begin producing chips in the United States. For more on this and the U.S. Stance towards China, we welcome in Arizona Senator Mark Kelly. Senator Kelly, thank you so much for being here. Before we sort of dive into the CHIPS Act, I wanted to ask you a sort of bigger question that the CHIPS Act is part of, because we have this act now open for applications. We had a House hearing late yesterday, sort of with how the U.S. should be approaching China from a policy perspective, right? That is all happening. We had Chinese economic data this morning. And so first, I wanted to sort of get your big picture thoughts on how the U.S. should be approaching China right now at a time when tensions have been rising.
Well, they're our biggest, geopolitical adversary, right now, clearly. I mean, we've got this war in Europe between Russia and Ukraine. But when you think of the biggest threats to the United States right now, I would, put China at the top of the list. And that's why as soon as I got to the United States Senate, one of the first things I started working on was this CHIPS Act, which is the legislation that is ultimately going to fix the issue we have with semiconductors. The best semiconductors in the world right now are made in Taiwan, very close to China, supply chain on the other side of an ocean. We rely on these chips for pretty much everything, anything that has an on-off switch, but more importantly than that, sophisticated weapons and weapon systems. I spent 25 years in the United States Navy, flying airplanes off of an aircraft carrier as a test pilot. We need those chips. Well, now, because of this legislation, they're going to be made here in the United States of America.
And of course, Arizona has positioned itself as one of the locations that wants those chip fabs. We've already had some announcements from the likes of Intel and Taiwan Semi that they're going to be building some plants there. So what can you tell us about Arizona's plans for applications under the CHIPS Act, and kind of what your sales pitch is in Arizona as being competitive in this process?
Well, we were just naturally competitive because we've been a leader in this industry for decades. Intel already has a presence there. TSMC now is in the process of building one manufacturing plant. They're going to be building a second one. They've announced that already. So we're already, a hub for semiconductor manufacturing in the United States. This is just going to expand dramatically because of this legislation. It's also going to create really good paying jobs. I had an opportunity to talk to this young mom of 3 who was out of work for over a year. She couldn't find a job. And then she sees in her spam folder, she finds this thing about this thing called the Quick Start program. It was a program at a community college to learn some basic skills that then led to an interview. Well, she is now a semiconductor manufacturing technician at Intel. Great success story. So these are great paying jobs, important for our national security, but it's also important to the rest of the country because it's going to bring down costs.
How do you ensure that costs of living, as you have so much investment, so many new people that may be able to make their way into Arizona and sure find jobs and be able to start careers there? We've seen what that's been like in Texas. We've seen what that's been like in California in the past. How does Arizona make sure that the cost of living does not skyrocket with a lot of the injection of new talent and new companies that are looking to really earmark spending or allocate spending to build out their capacities in chips in this case?
Well, we're going to need other companies to invest in infrastructure in the state of Arizona, in and around these new companies. And it's not just the major chip manufacturer. It's not just about Intel or TSMC. There's all the other companies that supply them with the equipment and materials they need to manufacture what you could argue is, some of the most sophisticated hardware that our country makes. So we're going to have to make sure that there are companies out there building affordable housing, that the grocery stores are being put in. We've got a plan. We're in the process of executing this plan in Arizona. The Arizona Commerce Authority and the leadership at the state, I spent a ton of time with them to make sure that we're reaching out to all the right companies to get the additional infrastructure built to support these major companies.
Well, and on that front as well, Noah Smith recently wrote an interesting article where he talked about some of the barriers to construction in the U.S. and to building out industries, much of that on the local level. And so when you talk about removing those barriers, what does that look like in Arizona in terms of not just, bringing costs down for living, but also some of these companies that want to build have complained that the costs in the U.S. versus China versus Taiwan are just too high.
Yeah, and it's not just the cost to build. I mean, it's the cost of labor's higher. That's a good thing, actually. I mean, it's good that when somebody works in a semiconductor plant, they get a salary that they can actually raise a family on. That's a really positive thing. There are barriers. The CHIPS Act is addressing several of these. It's bringing the research and development here. It's bringing the manufacturing here. But there are also barriers, and not just with local and the state government, with the federal government. I was on the phone just yesterday with the Secretary of Commerce talking about some of these things, like, just as an example, the permitting process. It's a long process, and if you don't get ahead of it, and we're going to work with these companies to make sure they get ahead of it so they can meet their construction schedule, but at the same time follow the federal government regulations to make sure we're not harming the environment. So it is it's got to be sort of an all government approach, and other agencies are involved, just not Commerce. There's also DOD, and clearly the United States Congress and my colleagues who got this legislation across the finish line.
Senator, you sort of alluded to this a little bit, but the federal government grants are coming with conditions. And this is something I talked to the Commerce Secretary about as well, including that the companies that receive money are not supposed to use that money for buybacks, for example. And also, on the topic of that employee you mentioned, affordable child care, that these companies have to ensure that that is available. The companies that you've been talking to who want to locate in Arizona, have you heard any pushback from them on these various conditions?
Well, first of all, let me make this clear that this is not a blank check. This is a lot of money, a lot of taxpayer money. Taxpayers worked hard to make this money. They pay taxes. We're going to invest this to the benefit of the United States. But they just can't go do what they want with it. So there are some constraints here. They can't use the money, just as an example, the CHIPS money for stock buybacks. And we're sending a strong message that is not appropriate to even use, other sources of funding. On the child care situation, they need to find a lot of employees. And one of the barriers, especially for women, talented women that could be in the workforce, is childcare. So, a provision, that came from Commerce, I think it came out of Commerce, to encourage or require these companies to have childcare. This is a win-win situation. It helps families in Arizona and in other states that are going to have these companies there. But at the same time, it helps the employer. It's going to help them attract the workforce that they need. In Arizona, we're not just talking about thousands of new jobs. This is potentially, when you consider the chip manufacturers, but all the other companies out there, it's tens of thousands of good paying jobs.
Senator, I couldn't help but think about, when you were talking about the workforce, the number of CEOs who we speak with and business executives who have said that we need better immigration policy, that we need more reform to be able to make sure that we are solving for the employment gap right now. And with the creation of all of these new jobs, making sure that those opportunities are filled. What steps would you like to see taken on that front, given Arizona's border state status?
3 words: comprehensive immigration reform. It's important to our economy. I mean, we've got very low unemployment right now. Companies could grow, and it could help us grow our GDP if we had the workforce we need. Some of that workforce can come from overseas. Some of it we can grow, locally through community college programs. We've got programs in Arizona that do not require a 4-year degree that'll lead, like the example I gave with the young woman with 3 kids, that'll lead to good paying jobs that you can raise a family on. We're a border state. We've got a border security problem. We need strong border security, but it's important that we also recognize that we benefit from a strong immigration system that helps us bring the additional workforce that we can't develop locally here to our country to support an expanding economy.
Senator, it feels right now like many Americans see that immigration system as a mess, simply put. Of course, there was that New York Times story out over the weekend about migrant children who are working underage in factories across the United States, many of them, if not all of them, coming across the border. At the same time, that, as you say, there is this need for immigrant workers. CEOs we talk to all the time cite that as an acute need, that they want immigration policy to open up to allow them to get more foreign workers. How do we fix this, especially in a divided Congress?
Yeah, Julie, I would agree with you. It is a mess. It needs to get much better. And it's on us. It's on Democrats and Republicans working together, working across the aisle to do stuff that clearly benefits our country. Often, this issue, I would say, as much as, or maybe more than any other issue that I can think of, becomes political. And it becomes about an election, and it shouldn't be that way. We should be making decisions here in the United States Senate that is, based on one thing: what is in the best interest of our country.
Are there any common points on the immigration issue that you actually think that Congress can make some progress on?
Many. Whether it's Pathway to Citizenship for Dreamers, who I look at as American as my own 2 daughters, or what you mentioned, which is we need more folks to fill these jobs. They can be very technical jobs, but there's also the agriculture. Jobs are we don't have the workforce we need in the state of Arizona. I can talk to my colleagues in other states; they've got the same exact problem, regardless of where. I mean, if you're in the agriculture industry, you're having a hard time finding the workforce you need. There's an H-2A visa program. It's too complicated, and there's not enough of those visas available. So this is something that benefits our country, and it allows us to grow our economy. It's up to us to continue to work on this. I hear my Republican colleagues, most of them that I talk to about this, they get it. We've just got to figure out a way to put the politics aside and just make decisions based on, in my opinion, science and data and facts.
Senator, your history is well documented. Your service as a U.S. Navy combat pilot, a NASA astronaut. We'd be remiss if we didn't at least get one question to you about space, and particularly where we're seeing even more launches come in the partnership of both public and private entities, notably NASA and SpaceX, really catching headlines recently here with the number of launches that have continued to, I dare to say, skyrocket over the last couple of years here. Where would you like to see space exploration further so that people here on Earth can actually reap some of the benefits and the allocation of dollars that goes with that too, as prescribed by Congress even?
Well, let me be clear about this. The U.S. taxpayer benefits greatly from the investment that our government has made in our space program and the aerospace industry. We've been a leader on this for decades now, from the time we first started sending people and then satellites into space to where we are today. Thanks to SpaceX and some other private companies, the cost to get a pound of payload into orbit has gone down dramatically. that helps. I mean, it helps our telecommunication industry. It helps our ability to forecast weather and, to deal with climate change. It helps the military with surveillance and intelligence, reconnaissance, those type of things. So this has been a big benefit. And I want to see it continue. I feel like we are in what aviation was like in the 1930s. There was an airplane that was built, first airplane that could, carry a good number of people, could make a little bit of money, and it was safe enough so they didn't routinely have accidents. And that was the DC-3. We're now seeing here about a little less than 100 years later, the same sort of thing happening in space, specifically in low Earth orbit. But this also allows NASA to send people back to the moon, one day onto Mars, learn more about our solar system. More knowledge, just helps benefit us as a country.
For us lay people, we just call it cool. Arizona Senator Mark Kelly, thank you so much for spending some time with us here this morning, talking about the CHIPS Act and a lot else besides. Really appreciate your time. Thank you.
Well, you're welcome, Julie. Thank you.
Well, you just saw that the opening bell was happening on Wall Street. If you take a look at how we are trading here to start out this morning, not a whole lot of movement, right? The Nasdaq, little change to the downside. The Dow and S&P down a little bit more, but really just about 0.25%. Just to remind you, we are getting some economic data in about 15 minutes and then 15 minutes after that. So that could move the needle a little bit more. But Brad, what are you seeing at the Interactive here this morning?
Yeah, I'm seeing some red right now on the Dow Jones Industrial Average. Slid on over here to the Wi-Fi Interactive just to take a look at these major averages. The Dow, I'm pulling up a year-to-date view for our viewers so you could see the setup coming into the start of March here. Here on March 1st, we open up the day down by about 0.2% for the Dow Jones Industrial Average. Nasdaq Composite, which is up 9.3% year to date, down to start off the morning and the month by about 0.1% here, but we got a lot of month left. And the S&P 500, you're seeing that in the green over the year to date. That's up by about 3.1%, but here today down by about 0.25% to begin things. Let's also take a look at the 11 S&P 500 sectors here. Out of the gate right now, you've got two sectors in positive territory. Materials moving higher by about 0.5%, we'll call it here. Utilities, though, bringing up that caboose. It's down by about 0.8%. We've got about 9 out of 11 S&P 500 sectors in negative territory right now, with a little bit of a flippity-flop technical term there in the communication services sector there. And then just lastly, riding out with a look of the Nasdaq 100, those mega cap tech stocks also doing a little bit of a flippity-flop.
You want to blow up Tesla there for 1 minute?
Absolutely,
since we got the
asking you shall
big old
receive.
Investor Day coming today. The Master Plan 3 is what we are awaiting from Elon Musk.
Absolutely.
Yeah, that's a big performance year to date, isn't it?
Yeah, and we've heard from Dan Ives, Wedbush analyst, of course, in the past, calling this one of the biggest short squeezes in Tesla's history that had taken place that really prompted some of that move. However, still a lot of fanfare coming into this Investor Day because there is the prospect of perhaps a new vehicle, a new model that might be discussed as well.
Yeah, some reports about a revamping of the Model Y, too, that I was reading about this morning. All right, Brad, let's move on to another mover. That is Novavax. Those shares are sinking some 24% after the biotech company missed estimates in its latest quarter and also warned of substantial doubt about its ability to stay in business through next year. So this is just the latest hit for Novavax. I mean, effectively, the company said it might go out of business, right? So this company didn't make anything until it made a COVID-19 vaccine.
Right.
And because the mRNA vaccines sort of were first out of the gate, had higher adoption, it just didn't gain as much traction, and it's been sort of struggling.
Yeah, this one had efficacy issues as well when its candidate was reviewed and ultimately went through trials, and so much so to the point where they could not get it released in that same time period and window as some of the others that were out there in market at that point for months, whether it was Pfizer, whether it was Johnson & Johnson, which actually still, even in their one shot, didn't have the same efficacy that Pfizer's or Moderna's had. It still was able to make it to market. Novavax was eventually only determined a viable option for some other countries around the world. And so with that in mind, sure, it does do a bit in helping us get out of the global pandemic. However, at the end of the day, in monetizing the ability for that vaccine to actually sustain Novavax's business for a longer term period of time, that's where it places the burdens on the financials, not being able to get that approval timely, and you're seeing this continue to be reflected over the long term for Novavax as well.
I mean, the numbers in the U.S. are pretty staggering. They sold 1.1 million doses of the vaccine. Yep. That compares with 400 million from Moderna and 650 million from Pfizer. So just to give you a little perspective, although, as you said, it did sell them around the globe. Let's talk AMC. AMC shares are in the red, despite the company beating analysts' expectations with revenue falling 15% year over year, but that was a smaller drop than estimated. The movie theater chain notes that the industry-wide box office will not return to pre-pandemic norms between 2024 and 2025 at the earliest. So that could be one of the things, perhaps, that is holding back the shares, the fact that attendance is still not up to snuff. But if you look at the revenue breakdown in the various areas, admissions revenue down 16%, food and beverage revenue down 13%. You know, that is obviously problematic. Consolidated attendance down by 17% year over year.
If there was a period for them to not just do well, it had to come off of the back of some of the best performing titles that we've seen in history, being able to have yet a new release. And I'm looking at and thinking about Avatar and all of those that are in the world of Pandora. At the end of the day, what titles are going to be able to have that same type of strength? And you have to look out into that schedule. And I think AMC having full insight into what titles, what content is set to be released. Oh yeah, and the competition that you're going to see with streaming platforms as well, bringing those titles more quickly to streaming. It makes the decision that much easier for so many consumers out there. Do I just wait for this to come out on Netflix? Do I wait for this to come out on Paramount Plus? Do I wait for this to come out on Disney Plus? And that was the conversation people were having in movie theaters pre-pandemic anyway, when they saw the previews rolling.
And then let's talk about AMC from a sort of financial engineering perspective, right? And CEO Adam Aron, who has been so good at courting the retail community. Here's the APE units trading at a sharp discount to the AMC shares. These are the AMC preferred APE units. There's a hearing coming up in mid-March on March 14th about the conversion of these shares into the regular AMC shares. But that has really been an overhang. This was a way, effectively, let's say this was a backdoor way for the company to issue more shares without getting approval from the company shareholders to issue more shares of its common stock, right? It's a little bit of a complicated financial engineering. And it seems like it's not a slam dunk here, although Adam Aron has done a lot of things that have been smart from that perspective. This one, it's unclear whether it's going to work out as he intended.
Yeah, this perhaps the one ding on the extended term kind of financial moves that they've made. One of them that they did twice was just trying to bring in more capital. They did at the market equity offerings twice, I believe during 2021, when so much of that fanfare was there for them to be able to capitalize in on being able to just add more capital to the coffers as well for the near term. Also, everyone, shares of HP in focus this morning following a mixed quarter. The PC and printing giant saw fiscal first quarter sales drop 18.8% year over year amid a more cautious spending backdrop among consumers and businesses. Our very own Brian Sozzi sat down with CEO Enrique Lores to discuss the most recent report. You will not want to miss that. And coming up next, we're going to take a litmus test of the U.S. consumer. It's time for your morning brief.
Data out from the Conference Board yesterday showed consumer confidence dipped in February with the decline entirely driven by expectations for the future. That means U.S. consumers keep feeling better about today and worse about tomorrow. You can read all about this in today's morning brief over at the Yahoo Finance homepage. For more, let's dive deeper with Charles Schwab's chief investment strategist, Liz Ann Saunders. Liz Ann, it's great to see you. Man, this just adds to the confusion out there, it feels like, doesn't it? You know, you got strong jobs numbers, you have inflation data that's a little bit alarming. Like, what do you do with all of this, given that we have that consumer confidence number?
Well, interestingly, consumer confidence from the Conference Board, based on the questions that are asked, tends to have a little bit more bias to the job market versus University of Michigan consumer sentiment, which tends to be biased a little bit more by inflation. So that helps to explain some of what was a significant divergence last year, where consumer sentiment, because of how ugly the inflation backdrop was, plunged to record lows. I think the consumer confidence is interesting with regard to the labor market, given that it's the expectations component that is weaker. And that probably reflects the concern about these pretty high profile layoff announcements. And what's also unique in terms of the backdrop from a labor market perspective, particularly the layoff announcements, is unlike a normal downturn or an historical downturn in the economy, soft landing, recession, leaving the label aside, you tend to see bottom up in terms of layoff, meaning lower level workers, lower wage workers. This time it's sort of the managerial level, the supervisor level, up the wage and income spectrum, and that's where the hits are coming first. So yet another thing about this cycle that is just so different relative to past cycles.
For the consumer-facing companies, or the most consumer-facing, at least on the household front companies, what grade would you give them from this earnings season, what they've signaled, how they're managing and navigating in this uncertain period that they've all discussed and are trying to best position themselves for?
I think they're starting to move up in terms of grade as it relates to how they've handled the inventory glut that was a big problem, particularly in the latter part of last year. And you now look at inventory levels that have come down, in some cases, maybe a bit too much. So the defensiveness due to what is called involuntary inventory drawdown, because the combination of there having been too much and the fact that demand has been a bit weaker. But what's also the case, and this isn't just for the retailers, but overall for the S&P 500, a lot of the pricing power was simply tied to inflation. If you look at top line growth, revenue growth for the S&P, almost all of it is explained by inflation. And other than the recent tick back up in inflation, to the extent that the trend is still down, and certainly well down from when CPI had a 9 handle on it in June of last year, I think we're going to start to see the separation of companies that truly have pricing power in a disinflationary environment and those that only had pricing power because that was the inflation backdrop. We didn't quite pick that up fully yet in fourth quarter earnings. I think that will become much clearer when we get to first quarter 23 reporting season.
And I know that you have also written about valuations here and earnings estimates coming down. Certainly companies themselves are resetting expectations. Analysts are too. Have they come down enough? And what is that going to mean for valuations as we head throughout the rest of 2023?
They probably have not come down enough. One of the factors most highly correlated to corporate earnings is the 10-year yield with a lag, and in particular, the recent move up in yields and the likelihood that the Fed has to kind of keep its foot on the economic brake for maybe longer than what was thought a few months ago. I think the path of least resistance for estimates is still down right now on a dollar basis. And there's different sources for different estimates, but using Refinitiv data, I think you're about $218 for S&P earnings for calendar year 2022. And you're still a few dollars north of that, somewhere in the 223 range for calendar year 2023. And I don't think it's a stretch to think that 2023 will be a lower number than 2022. So there's still probably more room to go on the downside. And if the Fed really has to press this to sort of engineer more of a hard landing, pick up on the unemployment rate in the interest of getting inflation down closer to the 2% target, then I think you have more significant downside to come in earnings estimates, particularly in the first half of this year.
What are 3 tips that you might have for the investor that's trying to see through what we've been hearing described as an economic hurricane in some cases, or just more broadly, a storm, and with a mix of factors that a range of CEOs are discussing and trying to themselves see through as well?
I would always say, don't fight the Fed. That was a phrase coined by my first boss and mentor in this business, the late, great Marty Zweig. I think in this environment, it's really important to heed that message. I also think that investors need to expect more volatility. And I'm not just talking about stock market volatility. I think the end of the great moderation era is very much here. I think the era we're in now in a secular way looks entirely different than that 20+ year period of great moderation. And that's because gone are the days of cheap access to goods, cheap access to energy, cheap access to labor. I think all 3 of those ships have sailed, and I would therefore expect greater inflation volatility, economic volatility, probably geopolitical volatility. We're in this era of regionalization and demographic shifts that are pretty painful. That's not without opportunities, but just understand it's in the context of more macro volatility. And then, of course, with the return of the risk-free rate, it's brought, I think, secular changes, including the fact that fundamentals are reattaching to prices. It helps explain why equal weight has been generally doing better than cap weighted, why active has been generally doing better than passive, or at least on a more level playing field with passive. And I think those are secular and important as backdrops for investors to think about.
Charles Schwab's Chief Investment Strategist, Liz Ann Saunders, as always, thank you so much for the time and the insights. Really appreciate it.
Thank you.
And coming up, we talk with the CEO of Luminar about its latest laser sensor. Stick around. It's going to be lit.
LiDAR, which stands for light detection and ranging, uses lasers to allow cars to see, effectively, other vehicles and potential obstacles. And Luminar has been viewed as a LiDAR darling, largely for being one of the first to go public. It's early to win high-profile production contracts. The company recently reported fourth quarter results and unveiled a new LiDAR sensor that's already begun to ship to its lead customer, along with its other initiatives. With other automakers adopting LiDAR to make vehicles safer, is Luminar shaping up to be the leader of the automotive revolution? Here to discuss is Luminar Technology CEO Austin Russell. Austin, good to talk to you. I guess we'll know that we've gotten to a different point where we don't have to explain what LiDAR is, but I think a lot of people are still wrapping their heads around it, right? So you guys released earnings. You talked about your new initiatives during your investor day. I guess I'll start with, what are you most excited about for 2023 in terms of what Luminar is planning?
Yeah, so I think we're certainly accelerating at full speed ahead on all fronts, and I would just say for this year, I mean, we've sort of announced this sort of flurry of news, and from showing that we can holistically execute while at the same time showing different sort of paths for additional growth, and everything from you mentioning from kind of the new product for Iris Plus that has even longer range of capability, high performance, and is now actually the product that will be shipped as part of this multi-billion-dollar Mercedes-Benz contract and plan that we have with them for their vehicle lineups. And at the same time, it's really all about scale. So we're focused on getting this high volume automated factory that we have in Mexico online. That's actually, we're doing that ahead of guidance now for Q2, and then focus on the validation for that throughout the rest of the year. And then among other things there too, we're making it happen, announced a handful of new partnerships too to be able to accelerate that growth.
Still, this really requires so much regulatory red tape to still be moved through. And what are you hearing from regulators who are trying to get a better sense of how the technology can be infused in any autopilot or self-driving mechanisms in the future?
Yeah, I mean, I think you're seeing some huge regulatory tailwinds here too, from a push more generally for safer vehicles, and I think this has never been exemplified more when it comes down to it. So I think it's interesting is that from a regulatory standpoint, it could actually be like a barrier when you're trying to be able to replace drivers on cars, but that's never been our vision. Our vision and plan has always been to enhance drivers, not replace drivers. And that's exactly what the automakers that are working with are doing and leveraging our technology for. So, when they're scaling it, I think that, part of the long-term vision for what we have is, we have this 100-year vision to be able to have the opportunity to save as many as 100 million lives and 100 trillion hours out on the road over the next 100 years. And saving lives is what it's all about, and can also make massive amounts of money. So I think, it actually ends up working in our favor.
Austin, you talked a moment ago about accelerating sales growth, right? And I'm looking at one estimate for your price to sales ratio at 73, which seems high. The stock has bounced about 70% this year after falling 40% over the last year. When can investors expect, most investors don't have that 100-year plan, right, to make driving safer. When do you expect to see more of an exponential acceleration in that revenue growth?
Yeah, literally starting this year. I mean, we're talking about breakneck triple-digit growth, that we've given guidance for the next several years. And when it comes down to it, I think the relevant side of this here is this is not a traditional kind of business there too, where quarterly or even annual revenue is relevant at this stage. It's people are generally makes much more sense to be able to look at, for example, a highly credible, forward-looking order book that where that revenue can be realized, from that over the course of, this decade and beyond. And for example, we showed how we had, over 60% growth in that, and even from a conservative standpoint, that was at around 3.4 billion. So I think we're actually, that's around what probably the valuation. It's probably like less than 1x order book or something. So from that perspective, I guess it's all about perspective. But basically, we're showing that that from what we have today, there's a very, very clear trajectory, even just using 75% of awarded business that we already have today, where you can have $1 billion in revenue at a run rate by 2026, 2027, or at least $1 billion. Or I'd say 1 million vehicles per year, translating to $1 billion in terms of run rate. So it's cool to be able to see. And then basically by 2030, you're talking around 5 billion vehicles per year, or 5 billion run rate, with the opportunity for a 60 billion forward-looking order book. So the thing with the auto industry is it's like a flywheel with this. Once you get designed in, these are long-term arrangements. I mean, we're talking about like 15 years in total of how you build and accelerate these programs and platforms with automakers and what you have to support it for. So it's getting very real, very fast. But the key is just about execution. We have everything set up for the greatest possible success and, just orders of magnitude growth. But we just got to make that happen.
At what quarter this year do you see that translating into profitability?
Yeah, so actually that was part of what we were talking about. So we for the first time, we're sort of unveiling this path towards profitability and showing that we're going to do this not just in the long term, but actually in the plan is to do this in the nearer term as well. So we're able to show that we actually as soon as next year on a run rate basis, by the end of the year can be profitable for our core business. So this would certainly be a first, for the, autonomous vehicle space and revenue generated from that, of course, generally. So, it's good to be able to push the bounds of that and be able to actually show what's possible by all means from that perspective and getting cash flow positive for that. And then for the following year and on a run rate basis, we have the opportunity to make it the business as a whole profitable.
Austin, it's great to see you. Luminar CEO Austin Russell. We'll catch up again soon and talk more about everything you guys are working on. Thanks.
Awesome. Thank you.
Well, on the topic of autonomous driving, Yahoo Finance's Brad Smith, the guy sitting next to me, is going to break down key Tesla terms you need to know ahead of the company's Investor Day. That's happening in the 11 o'clock hour, so stay tuned for that. And here he is.
Hey, they didn't tell me about that. No, I'm just kidding. I'll see you guys in the 11. But I'm going to stick around for a little bit more. Let's talk a little bit about Rivian this morning. Ticker symbol RIVN. Those shares driven downwards after reporting mixed quarterly results and as its new production forecast for 2023 falls below analyst estimates. There you're taking a look at some of the actuals versus those analyst estimates and missing on both the top and bottom line here for the company.
Yeah, I mean, it's so interesting how it just continues to be. We keep talking about competition for Tesla, right? And yet it still kind of continues to be Tesla and everyone else, right? In the electric car industry.
Well, it's also the pricing that Rivian decided to come into the market on at the time where Ford had also started to roll out what their options would be for the market. So the broader consumer mindset is, all right, well, do I just wait for who has been the category leader in vehicle sales in the Ford F-Series to electrify in terms of the Ford Lightning that they've now brought to the market and started to take orders for? Or do I go pay a little bit more for that Rivian or wait until whenever for the Cybertruck to come out at some point?
Yeah.
Those are your electric options, as well as, of course, what GM is putting out there too. A little crab walk Hummer, that seems cool. But at the end of the day, the price tag is really what it's going to come down to, especially operating a vehicle of that size, knowing how frequently you would have to charge it too.
Right. And when we talk about also, whether it is Rivian or Lucid just announcing production targets that were below estimates, really the question is it a demand problem? Is it a manufacturing problem? Is it both, right, that's happening? I did see one analyst comment who was an analyst over at Cantor Fitzgerald who was encouraged that the company now expects to achieve positive gross margins next year. So there are, maybe signs that Rivian is trying to sort of get its house in order here and that all of this is partially growing pains. I mean, also think about, because of all of the companies that came to market over the last few years in 2021, did some of them come to market prematurely? Like, what if Rivian was still a private company? What would that look like? What would this process look like if it was still in private hands? Maybe you wouldn't have as much capital to do things with, but I don't know. It's doing this all in public view, which is painful.
Yeah, and I mean, even their private stages as a company also still very much in public view. The investments from Ford, the investments from Amazon as well, and of course, Jeff Bezos' annexation to it, driving one up to every single Blue Origin launch. That helped and a net additive for some of the marketing elements. But at the end of the day, I think one thing that investors and one thing that customers are looking for here is the strength in battery and who is able to win out on that battery pack here. It's important to remember that R1T with the standard battery pack, 260 plus mile range, the max pack has 400 miles on it. And so expect to hear more about that competition on the battery front, especially as all of these automakers are looking towards what's been the best categorical or model seller, and it is the pickup truck. Rivian trying to make sure that they maintain some of the market share that they've amassed and grow that out as well.
Yep. Coming up in the next hour, is HP running out of ink? The printing giant reported a mixed quarter with sales dropping 18% year over year, but CEO Enrique Lores said the decline in sales is all thanks to the macro economy. Yahoo Finance's executive editor Brian Sassi is going to join with the latest. Plus, Meta making some major virtual moves. Could AR glasses replace smartphones? Only time will tell. Dan Halley will join us to chat the tech giant's ambitious VR and AR roadmap. And also in our 11 a.m. hour, we are going to, as promised, talk all things Tesla ahead of its investor day. Reports of a revamped Model Y and new factory construction putting the pressure on Tesla's rivals in the EV market. And Brad will have that glossary we were talking about. Stay tuned. Much more coming your way on Yahoo Finance. Welcome back to Yahoo Finance. I'm Julie Hyman alongside Brad Smith, and we're taking a look at breaking economic data out right now on manufacturing. Manufacturing is still weak, but accelerating. I guess that is the bottom line here. At least accelerating if you look at the Institute for Supply Management's manufacturing gauge, which is at 47.7 for February. That's still below 50, so it's still in contraction, but it's better than the 47.4 that was reported in January. We earlier got S&P Global's U.S. manufacturing PMI. PMI is Purchasing Managers Index. That came in at 47.3, again, below 50's contraction, and it showed a drop. These different measures do have sort of different compositional elements. That's why sometimes you see them diverge. The bottom line is we are still seeing manufacturing contracting in the U.S. The prices paid component of the ISM index rising to 51.3. So that ain't good news either, folks, when you have manufacturing contracting and prices rising. At the same time, there was an improvement month over month in the ISM reading, and that's the first time we have seen that in 6 months' time. So, adding to the batch of data where you have a little bit of good, a little bit of bad, the prices rising segment of it, not great news. It is the second straight month that we have seen that on the rise, Brad.
Yeah, a little bit of good, a little bit of bad is also what we're tracking here on the major averages this morning on this Hyper Waffle Wednesday. Take a look at the Dow Jones Industrial Average, touching both sides of the trade there. Positive, negative. Love it, hate it, whatever. Right now, flat, but to the downside. We'll see ultimately, and this is calibrating here. It's not even sure which way things are going right now, so we'll continue to watch that. The Nasdaq Composite, right now, you're seeing that down by about 0.2%, no question about that. That was positive during the first 30 minutes of trading for a bit of time here, but you've seen us move back into the red there. S&P 500, you're seeing that down after touching positive territory for just a little blippity blip. I didn't have our highlighter on, so it's not going to circle. And we're down right now by about 0.25%. Let's take a look at some of the sector activities to see where that is holding up. For the 11 S&P 500 sectors, you've got 3 of those in positive territory right now. Materials was one of the ones that we were tracking earlier. You see that continue to advance here a little bit. That's up by a little more than 1%. Energy now up by about 1.1% as well. You're seeing that activity. Let's put this on a year-to-date view just so you can get full context of how we're beginning the month for energy. Down year-to-date by about 3.25%. Real estate and utilities and consumer discretionary pulling up the caboose. Big week for consumer discretionary. We're continuing to get even more earnings. Costco going to be in focus as well. We'll see exactly what that mindset of the consumer is. And then just lastly, let's ride out actually with a view of the Dow components. Let's switch it up here for you a little bit. Taking a look at all of these components in view on our heat map. It's actually Intel leading the way on the day. That's up by about 3.5%. Year to date, though, still down by about 2.5%. Pulling up the caboose there. Home Depot down by about 2% right now, Julie.
Wow. All right. Gotcha. Atlanta Fed President Raphael Bostic out with an essay this morning noting the need to raise the Fed's policy rate to a range of 5% to 5.25% and hold it there until well into 2024. Bostic's reasoning is the Fed must, quote, determine when inflation is irrevocably moving lower, but it has yet to reach that point. We've also got comments out from Minneapolis Fed President Neil Kashkari. He is open-minded about whether it's 25 or 50 basis point hike in the next Fed meeting. He says he's currently leaning towards continuing to push up his rate and policy path. U.S. and global dividends rose to record figures in 2022. This according to the latest Janus Henderson Global Dividend Index. However, higher rates may have already begun to affect companies' willingness to grow dividends, spelling trouble for growth in 2023. Here to discuss is Matt Perrone, Janus Henderson Investors Director of Research. Matt, thanks for being here. As we look at companies, the big dividend growth that we saw last year and companies' sort of strategy with regard to dividend, now that we look back on it, did it feel like companies were really prioritizing dividends in what ended up being a declining year to try to get people to buy the shares?
Well, I think there's some of that for sure. I think the main driver was strong earnings growth. I mean, despite the fact that there was valuation compression in the market, the fundamentals were actually quite strong. You saw decent earnings growth, and that was passed through to companies to enable companies to increase their dividends.
Okay, and so with that, even further now, where can investors, and how should investors evaluate some of the dividends that have been announced and where we could still see more of the dividend increase or growth out in the market?
Yeah, so last year, most of the dividend increases came from the oil and gas and the financial sector. That was the large majority of the growth in dividends. We'll probably see a continuation of that this year, although we expect it really to slow down quite a bit. So maybe a bit more even, but still strong from those sectors. In particular, we expect. But at the headline number for 2023, we're really going to probably see muted dividend growth. Maybe just 2% is our current thinking. And that's because we really saw a lot of sequential decline in dividend growth as 2022 progressed, and we'll probably see that continue here into 2023.
And 2023, of course, already has shown itself to be a year in which companies are cutting back in other areas, right? Whether it's layoffs, whether it's CapEx, et cetera. In this kind of an environment, historically, what have we seen happen with dividends? You said, companies won't be raising by much. Do we tend to see them cutting that, or is that sort of the last thing that companies want to cut?
It's really the last thing that they want to cut. So I think your point is spot on in the sense that we're not going to, they're not spending a lot. They're not in a spending mode, right? But they do want to show that dividend increases, commitment to dividends and dividend increases. So they really are the last thing to cut. In the pandemic, we saw companies in the U.S. in particular, cut their buybacks first, maintain their dividends. So you didn't really see in the U.S. a lot of dividend cuts. You did outside the U.S., but inside the U.S. they protected that by cutting the buyback programs first. And that's probably what you'll see again this year. If it gets to be a tough year fundamentally, you'll see buybacks go, dividends maintained. They'll try and increase them a little bit. That's our forecast, just to show year-on-year increases, because that's important to investors.
For investors that are trying to make sense of whether a company is actually healthy when they make these dividend announcements, when they make the buyback announcements as well, what is the best way to go about that evaluation?
You really want to look at dividend coverage. Are their earnings, are they generating enough earnings to cover their dividend to continue to pay out? That's the number one factor you want to look at. And in general, across the U.S., you see pretty good dividend coverage. So you feel pretty good that the U.S. is able to continue to make these dividend payments, and potentially there's scope for some increase just at the current level of coverage.
Matt, I know this report had to do with dividends, but I'm also curious about allocation for stock buybacks, especially because that's been a hot topic as of late, and sometimes a controversial one if you look at through a political lens. But what do we see, again, traditionally about sort of dividend trajectory versus buybacks? We've already gotten a lot of announced buybacks this year, even in this sort of cutback environment.
Yeah, so buybacks are really more popular in the U.S. than outside the U.S. But in the U.S., there's quite an active buyback program. It's a very important tool to return cash to shareholders. Something that's been rewarded in the past, few years, even decade. Investors really want to see, good allocation, capital deployment in their companies that they own, and a commitment to buyback and returning cash to shareholders in general is very important. So I think you'll see that as a really important lever. And what's good about buybacks from a management perspective is that you can dial it up and dial it down as you feel that either the valuation of your stock is at a reasonable rate or level, or if there are stress or somehow earnings aren't coming through, depressed earnings, et cetera, then you can dial them down, as we saw during the COVID episode.
Matt, thanks so much. Appreciate your time. Matt Perrone is Janus Henderson Investors Director of Research. Thank you.
Thanks for having me.
Coming up, PC and printing giant HP reported a mixed quarter with sales dropping 18% year over year, but CEO Enrique Lores said the decline in sales all thanks to macro factors. Yahoo Finance executive editor Brian Sozzi is going to join us with the latest.
Warren Buffett's annual Berkshire Hathaway shareholder letter is set to be released on Saturday. Now, the letter digs into Buffett's top holdings, how his investment strategy has played out over the last year, and what could come next for the firm. Yahoo Finance's Josh Schaefer is here with a breakdown of those top holdings. Josh, on over to you.
So like most investors, Warren Buffett's diversified portfolio has consolidated over time. As of December 31st, 2022, Berkshire Hathaway's top 5 holdings made up about 75% of the company's entire portfolio value. Apple is Berkshire's top holding, accounting for about 40% of the company's portfolio. That's about 4 times the size of the next closest company, Bank of America, which accounts for just more than 11% of Berkshire's holdings. Up next is Chevron. The oil giant accounts for just shy of 10% of Berkshire's holdings, while Coca-Cola, one of Buffett's most famous investments, particularly given his insistence on always sipping that soft drink, represents 8.5% of the portfolio. And American Express, a longtime holding of Buffett, rounds out the top 5, accounting for 7.5% of Berkshire's holdings in this.
So I guess the question is, when the Oracle of Omaha bought these, how have they done? How have these stocks done since you've bought them?
Right. So let's take a look at Apple first. And you would think buying Apple in 2016 might have actually been late, right? I mean, the iPhone came out right around here, and you see a big jump there. But really, when you take a look at where they bought it in 2016, let me just get my pen going here. They bought it in 2016 here. And then it took a big jump after that. And then they've sort of benefited from Apple's growth in iPhone services and sort of the services and cloud as a whole. Then when you take a look at Bank of America, they bought Bank of America, if we pull up a 10-year chart, they bought Bank of America in the early part here, back actually in 2011. So they bought Bank of America down here. You can see the ride that Bank of America went on after that. So in some senses there, it was about buying Bank of America at the right price, basically buying almost the bottom of Bank of America, even lower than the great financial crisis. And then I want to round it out with Coca-Cola. This is a stock that Warren Buffett has owned for a long time. Going back to 1988, that's around the time the Powerade came out. Coca-Cola's Gatorade equivalent, right? And sort of you can see how they benefited from the long rise of Coke. When you take a look at a Coke Max chart, you can see that that stock all time is up over 4,000%. And you can really see the big jump here that happened after Berkshire bought in those early days. Because again, guys, it's about, for Warren Buffett, it's about holding on for a long time and benefiting from those product innovations. Coke Zero didn't even come out until about, I think it was 2005 or 2006. So think about how much that company's changed since '88. Over 30 years later, they're still along for the ride.
And there's a reason why he's known as such a legend, right?
HP logs in another mixed quarter as the PC and printing giant saw sales drop 18.8% year over year amid industry-wide headwinds. We have Yahoo Finance's executive editor Brian Sazi here with us on set with all the details. Saz.
Yeah, always great to be on the show here. So HP, you're probably going onto the Yahoo Finance platform wondering why isn't the stock getting hammered? Sales down 18.8% year over year. Really, the street is pointing to a couple key things. One, profit margins in the printer business, key business for HP, haven't fallen off a cliff. And then number two, HP CEO Enrique Lora is telling me that the efforts to cut costs are starting to show up in profit margins. All those things are good. But to that end, still a worrying sales drop for HP in large part because of the economy.
Yes, I think the decline of sales is really driven by the situation that we see in the market, driven by macro. We saw a reduction or a significant reduction of the size of PCs, and this is reflected in our business, in our performance. From a segment perspective, what we saw is very similar to what we saw in Q4, a slowdown of demand in the consumer side. And then the new thing was a slowdown on demand on the corporate enterprise side, as companies are becoming more concerned and more conscious about managing their budget and slowing down hiring. On the other side, we saw, which is very positive, a reduction of channel inventory, which is something that we have also shared that we were planning to do. This is happening across the industry, and as it will be over by probably the end of Q2, beginning of Q3, this will have a positive impact on sales.
I didn't get the sense, guys, from talking to Enrique that the PC correction, which really started in earnest earlier last year, is coming to an end. It sounds like it will be a slow, gradual thing that eventually just dissipates. But again, they have to get beyond this if they want to see those sales grow.
Well, that's a bummer.
Yeah.
A bummer for him. Like what? So what do you, I mean, the thing is, if you are subject to a macroeconomic problem, whatever it is, what do you do about it?
Well, you just wait, I imagine, for consumers to feel more confident. And then also, it's not just an economic thing here. There is just a need. A lot of folks bought computers, PCs, new printers during the pandemic to work from home. And all of this equipment, 2 or 3 years old? I think Enrique, he told us at Davos, Julie, he's looking for a refresh cycle. But when does that start? It's not showing up in these numbers just yet.
Right, and how different does their business look by the time that refresh happens? And that cycle could be coming quick, could be coming months out from now or years out from now in that refresh, but how different does an HP Inc. look at that time?
Well, it does look quite differently, Brad, because they have had a workforce reduction a couple months ago. And I asked Enrique, when you reduce your force in size to the extent they have thousands of employees, what does that do to the culture inside the company?
Our goal is to achieve 40% of our three-year goal by the end of the year, and we will make that. In terms of the impact on the culture, we are being very careful on how do we manage this process. We think it's important when you go through a WFR process, for example, to treat people with respect, to make sure that they really feel compensated for the work they have done. And this is important both for the people that are leaving, but especially for the people that are staying. And this is why one of the reasons why we manage this process so carefully. One of the things we did this quarter, for example, is we announced a voluntary early retirement program in the US. 900 people are going to be part of that program. And we said that our goal for the next 3 years was to reduce our number of employees between 4,000 and 6,000 people. 900 is a very relevant part of that goal. And we do it this way because it's the right thing for the company and also for the employees.
And one thing that I've been wrestling with is what is the longer-term impact of these layoffs in tech land? Thousands of people off to find new jobs, whether they stay in tech or go into another sector. Does that impact innovation? Does it impact collaboration? Does it mean that we don't get the next big breakthrough on printers or PCs over the next few years? It's unclear how that will impact, and I think it's something that investors need to keep in mind as they study and analyze these companies.
Yeah, shares down more than 14% over the past year, even with this year-to-date run-up that we've seen by about 9%. Still a larger question of where that demand will start to reemerge for HP here.
Absolutely.
Also, thanks to Yahoo Finance's Brian Sazi, of course. Let's also take a quick look at the treasuries as we've seen a move off of that ISM data that we were discussing earlier as well. You're taking a look at the 10-year note. That's up 2% right now, 2.04% this morning, and that is the highest level we've seen since November?
Yeah, so the 4% threshold is really important here. Up 8 basis points here too. It just hit 4%. We're also taking a look at the futures here in real time. This is the price. So it means when this goes down, that means indeed we are seeing the yields go up. And what was it in that ISM report that is causing this reaction in the market? As we talked about, we're still seeing a contraction in manufacturing. That's not hot. What's hot is the prices paid component of ISM. As I mentioned earlier, it was above 53. So if you still have contraction in manufacturing, but prices are going up, that is not a great recipe. And yet another sign within a report that inflation is not necessarily decelerating. Are we even seeing the disinflation that Jay Powell was talking about? You know, granted, we're mostly getting 1 month of data here, some of the January data, some of the initial February data. But as it stacks up, is it going to challenge that notion of disinflation in a more fundamental way?
All right, we're keeping a close eye on the futures, or not the futures, the major averages here. Definitely reacting here on the day, down across the board versus some of the waffling that we had seen earlier. Coming up, it looks like Meta will continue investing in the augmented and virtual reality space. We look at fresh reports that give us some insight into Mark Zuckerberg's thinking. All of that up next.
Warren Buffett's annual shareholder letter is out. Here are 3 top takeaways from the Yahoo Finance team. First up, a call to action to all humans: start saving money. Buffett says this: it is those dedicated savers that are forefront in my mind as I write this letter. He adds, Charlie and I are not stock pickers, we are business pickers, telling people to save money. And maybe they're listening. The U.S. savings rate is now at a 1-year high at about 4.7%. I think Buffett wants to see it even higher. Takeaway number 2, investing school is in no session. Again, no surprise here in the Warren Buffett annual shareholder letter. Buffett noting this, saying, quote, the lesson for investors: the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. And yes, it helps to start early and live into your 90s as well. Warren Buffett, 92 years old. His longtime partner, Charlie Munger, 99 years old. Warren Buffett saying, if you want to be a successful investor, invest for the long term. No surprise, that's typical Warren Buffett being Warren Buffett. Takeaway number 3 here, a message or messages to all politicians here. Warren Buffett taking some jabs at folks in DC, noting this: Berkshire also offers some modest protection from runaway inflation, but this attribute is far from perfect. Huge and entrenched fiscal deficits have consequences. Interesting take there from Buffett. Buffett also says, really tries to, I think, champion stock repurchases, saying repurchases, those that tell people that repurchases are harmful to shareholders or to the country are particularly beneficial to CEOs. You're listening to either an economic illiterate or a silver-tongued demagogue. So Warren Buffett taking some swings at politicians. What we did not hear in this letter, no succession plan. Warren Buffett and Charlie Munger will be at that May 5th to May 6th annual shareholder meeting in Omaha. Brian Sazzi out.
We're tracking some major moves at Meta, the social media giant's hardware roadmap, including details about augmented reality glasses, virtual reality headsets, and a new smartwatch. All leaked in a presentation seen by The Verge. Here to get you up to speed, we've got Yahoo Finance's Dan Halley. Dan, what do we know about this?
That's right, Brad. This is an internal presentation to members of the VR team, the Reality Labs team over at Meta, and it basically laid out how Meta is going to be moving forward over the next 5 years, well into 2027, which makes me feel horribly old when I say that out loud. Basically, what they're going to be doing is rolling out a new version of their Oculus headset. Right now, we're at the Oculus 2. They're going to be rolling out a version called the Oculus 3 that's expected to be or offer some of the features of the Oculus Pro, that $1,000 plus headset that debuted to middling reviews late last year. They're also looking at expanding their line of smart glasses. Right now, they have a pair of smart glasses through Luxottica. That's the Ray-Ban glasses. I've used them. They're really interesting. They have cameras built in and everything, and you can listen to music while wearing them. But, you know, they're sunglasses, so you can't wear them inside or at night unless you're a super cool dude. They're also going to be rolling out an enhanced version of that with the ability to translate text. Then they'll have a version down the line that will actually be able to project on screen through the lenses real photorealistic avatars of people. So, you know, think how when Zuckerberg changed the name from Facebook to Meta, he showed that video of him fencing with an avatar. That's essentially what they're looking at. And that's supposedly going to be coming in 2027, and they'll start showing it to Meta employees in 2024. So, you know, this is a large rollout. We don't know exactly if they'll stick to that timeline. I think one of the things to point out is in this report, The Verge said that one of the VPs of VR at Meta pointed out that they're having trouble getting people to stick around, or newer people who bought the Oculus 2 to stick around with the headset.
And Dan, speaking of sort of the next new thing that maybe isn't living up to the hype, I don't know, you tell me. You're tracking the interest and hype surrounding chatbots and AI technology. So how should people be thinking about it? I mean, it seems like already people are taking a little bit of a breath here.
Yeah, so ChatGPT, obviously, you know, one of the fastest consumer products that we've seen as far as software goes. You know, millions of people signed up just as soon as it hit. Everybody's still playing with it. But there's this hype cycle that we're seeing kind of play out now. And that's really where all of these other companies are saying, oh, hey, I'm part of this too. Don't think that I'm not involved in generative AI. So we have, you know, Microsoft obviously rolled out Bing with ChatGPT. to kind of preempt that, Google announced its Bard generative AI chatbot. We also have Facebook, Meta, CEO Mark Zuckerberg rolling out a team that's dedicated to generative AI. Snapchat saying that they're adding ChatGPT. Spotify adding generative AI for their DJ. And believe it or not, Snapple sent me an email where they're using generative AI for people to generate their own Snapple facts. That's, just an aside, I guess. But, we're seeing this kind of hype train roll through. And it's partly these companies saying to their investors, look, we are in this space as well. Generative AI is not new. The kind of hype that we're seeing is based on OpenAI's ChatGPT, but we are in this space and we're working to roll this into our products. The negative is if people start using these products, since we're still, relatively early in the way they interact with general consumers, that they leave a sour taste in consumers' mouth. And that would be, the kind of hallucinations, they call it, where some of these chatbots just make things up, or, you have negative interactions. Microsoft obviously dealing with that. They're changing some of the capabilities of their Bing chatbot. And so, that, though, could push people away and make them kind of wary about using chatbots in the future. But, this doesn't seem to be similar to NFTs or the talk about Web3 or metaverse. This seems to be a technology that really has practical applications, but it's just the hype cycle that we're seeing. And, obviously big tech just kind of saying, me too, I'm involved as well.
Yes, definitely. We're hearing a lot of that, even from the companies that were doing it already, but weren't touting it in the same way. Dan Halley, thanks as always for tracking all this AI and metaverse stuff for us, for that matter. Appreciate it. Coming up, tax season is in full swing. That can be confusing to pretty much everybody. We've got a tax expert coming up right after the break who will help you navigate the IRS's latest rules on and deductions. We'll be right back.
Activists are circling Salesforce in a situation that's growing increasingly high stakes for CEO Mark Benioff. Right now, Salesforce is facing down 5 activists, all of whom are demanding better expense management from the cloud giant. Here are the 5 activists. 1, we have Third Point, led by billionaire Dan Loeb. He's previously picked a number of high-profile fights, including at Disney and Shell, and Loeb's the latest to join the Salesforce activist fray, revealing his stake back in February. 2 and 3, Value Act and Inclusive Capital. It's worth talking about the two in tandem because they have something in common. Jeff Ubben, who's the founder of both, and they've already notched a win. Mason Morfitt, Value Act CEO currently, and Jeff Ubben's handpicked successor, was already named to a seat on Salesforce's board in January. Fourth, there's Starboard Value, which got involved in Salesforce back in October. A source tells Yahoo Finance that Jeff Smith's Starboard is disappointed in the cloud giant's cost management, but isn't pushing for Salesforce to divest any of its mega deals, for example Slack, which is on the table for other activist investors. Fifth, Elliott Management goes for the jugular. The firm, fronted by Jesse Cohn and Paul Singer, often seeks board representation and even has a private equity unit that is known to bid on targeted companies. Sources tell Yahoo Finance that Elliott's stake is worth billions and that they're going to be pushing for succession planning from Salesforce CEO Benioff and better profit margins. So, where does that leave Salesforce investors right now? We asked Wells Fargo analyst Michael Turin.
I think right now, a lot of things are pointing in a favorable direction for investors around where Salesforce ends up over the next 12 months. The longer question is the harder one to answer on what is the 5-year vision.
Salesforce is reporting earnings Wednesday, so this standoff is heating up.
More than 60% of Americans are living paycheck to paycheck, according to Lending Club. And now with tax season in full swing, filers are looking to get their best returns and get the most back for their money. In the PBS show Opportunity Knocks, expert financial coach Luis Barajas works with families to understand their goals and challenges to help them overcome financial hardship. He's joining us now to go through the latest rules and deductions from the Internal Revenue Service. And this segment is brought to you by Fidelity Investments. Luis, thank you so much for being here. Obviously, there is a lot to sift through. So if you're just looking at sort of top line, big changes that the IRS has made that people need to know about, what would sort of be your top 3?
Well, I'll share with you that I think the IRS is actually uncomplicated stuff, right? Because they keep raising that standard deduction. And so the standard deduction now, like for married couples, is $25,900, and they raise it for single filers as well to $12,950. So what does that mean? That means that people in the past used to itemize. They used to take the medical bills, mortgage interest, property taxes, charitable contributions. And actually for probably about 80% of Americans, they can't even qualify for that anymore because the standard deduction is just so high, right? So we want to make sure that people are not intimidated and at the end of the day that they're taking either or. So, do the calculation on that. That's called the Schedule A, itemized deductions. But most of the time, I guarantee you, it's probably going to be the standard deduction. So don't worry too much about it. Now, what's going on this year real quick so everybody understands is that we've had a lot of issues with weather. And so right now, the IRS actually declared yesterday, a couple of days ago, that there's an extension for Alabama, Georgia, and California for the deadline is now October 16th, believe it or not. They had moved it to May 15th and now October 16th. But you have to be in a federally declared disaster county. So you can go to irs.gov and find out the information for you. So you may have a longer time period. What hasn't changed is IRA deductions, right? We're here on Yahoo Finance, and people need to make their IRA contributions by April 18th. So the deadline is not April 15th this year, it's April 18th. And so your IRA or Roth IRA contributions, it stayed the same of $6,000 that you can make. And if you're over 50, there's a catch-up provision that's for $1,000. Now, but for 2023, they're moving it up to $6,500. So if some of you are already who are listening to us or watching this have an amount where you're putting money away every month, you can raise that to $6,500 for 2023.
Oh, wow. Luis, there are so many people that have started a business as well over the past 2 years. And we've continued to kind of chronicle their stories. But for many of them, this is big time too, because they're going to have to start filing as self-employers. So what are the tips that you have for them?
Yeah, so you're going to get, so if you're self-employed, right, for the first time, and if you haven't created like an entity like a LLC or a C Corp or an S Corp, and you're just a sole proprietor now, you're going to file your tax returns on the same individual 1040 return, but it's going to be on the form Schedule C as a sole proprietor. So in there, you will be able to put all the income that you've received. You're going to be getting 1099s. That's where you enter the information on that Schedule C, the sole proprietorship. Now, what people don't know is that they can take any expenses that they use for that business that was ordinary and necessary. So if most people work from home, I'm working from home, right? If I've got a Schedule C, I'm able to take a portion of the where I work my area compared to the entire house, and I can depreciate that. I can take utility expenses. If I'm paying a mortgage, I can take expenses based on that percentage off of my self-employed income tax. I can take the property taxes, that percentage. And people don't understand that they can do that. So there's a lot. So if it's for the first time, you might want to seek a professional to help guide you to look for all the deductions that you could possibly take. And then it becomes, you can basically do it going forward.
Louis, I was going to ask you that when you need to hire someone, because obviously, especially if you are on the lower income side of the spectrum, you don't really want to shell out more for an accountant to do your stuff, or maybe even for one of the e-filers, right? So how do you figure out if that's what you need to do?
I will share with you, I've been doing tax returns since I was 14 years old, believe it or not, and I'm 60 years old right now, 61. So I've been doing it for a long time. So right now, I will share with you that if you actually do have a business, so it's the first time you've created your business for the last couple of years, I would seek a professional. If you own rental property, I would seek a professional. But if you're a W-2 employee, now, if you go to irs.gov or any other site right now, that they're offering free tax software that you can prepare your tax return, because again, the standard deduction has made it very easy. But you own your own business. Obviously, if you have your own corporation, if you have rental property, I would definitely seek out a professional, because there's so many deductions that you can take that most people are not aware of. I can't tell you how many times I've had to go back and amend tax returns for people who've done their own returns, who had their own businesses or their own rental properties, and they forget to depreciate the property. They forget to take what are called, like, for example, Section 179 deductions that most people don't even know about, means that instead of when you buy like a computer, instead of depreciating it, or you buy a printer, you can write it off, but you have to take an election called the 179. Most people will not know how to do that. So that's when you seek a professional.
Louis, while we have you, there's a lot of crypto hodlers out there. They're going to have to figure out exactly how they file this year's taxes, given some of the declines that we had seen last year in the crypto market. What advice do you have for them?
Well, again, most people that have crypto, again, if they bought crypto and then they sold crypto, they're going to have to report it just like the sale of a stock, the capital gain, right? But believe it or not, even if you didn't buy or sell it, on the tax return, there's a question that they ask you now, is that did you make any transactions with crypto? And you're going to have to answer yes if you did, otherwise there'll be a penalty. So you're going to treat it just like if a sale of a stock, right? Did you buy it and did you get rid of it? I mean, did you have losses? You can take the losses as well. So it's treated just like a stock on your tax return.
Opportunity Knocks financial coach Louis Barajas, thank you so much for taking the time and for that tax advice brought to you by Fidelity Investments.
Thank you. And go to opportunityknocks.net. That's where you'll find all our information. Thank you.
Done deal. Got my laptop in front of me. Going to go right there right now. Appreciate it, Louis. Guys, coming up, oil slipping as rising U.S. crude supplies balance higher demand from China. Stay tuned.
take a look now at some of the headlines coming out from the energy sector as speculation of higher demand out of China and elsewhere now being tempered by rising U.S. crude inventories. Joining us now, Yahoo Finance's Ines Frey, who's been looking at these energy headlines. So where should we start?
Yeah, let's start with gasoline demand because that has been on a trend downward. And I spoke to one oil analyst saying that this is significant and that he could see a permanent shift when it comes to gasoline demand in the U.S. So basically, Andy Lippo from Lippo Oil Associates was saying that between 2017 and 2019 is when we saw the peak of gasoline demand in the U.S. And in 2020 and 2021, of course, you saw demand going lower, but that's because of course, the pandemic. In 2022, gasoline demand was down 0.5% compared to the previous year. A lot of this had to do with the higher oil prices. But what is behind all of this? Well, I was speaking to Ed Morse of Citi, and he was saying, look, you've got early retirements, so less people in the workforce. You have the hybrid work schedule, so people are maybe going to work a couple of times a week into the office. The rest of the time they are at home. And then you have this greener shift towards greener cars. And of course, you have the gas prices that last year were up, and people are spending more money on food. They're spending money on energy, and they're trying to cut back in certain ways. So perhaps they're cutting back on their trips that they're going to the store. Look, as far as oil forecasts are concerned, we have seen a little bit of a pullback on some of the oil forecasts on the street, but you still have some bullish forecasts out there. A lot of this, of course, has to do with China and the recovery in China. You've got Goldman's Jeff Curry saying that in the fourth quarter, oil could go past $100 a barrel. Also keeping in mind, look, the commodity cycle is not just up an upward line, straight upward line. There are peaks to it. And then you also have, though, on the more bearish side, of the conservative side, you've got Citi's Ed Morse that says that Brent crude could be at $76 a barrel by the end of the year, WTI at $71 a barrel. Certainly, China reopening is bullish for oil, but keep in mind, just the way we also have trends here after the U.S. reopening and people going to the office less, et cetera, perhaps in China, that will also happen in certain circumstances where people, not necessarily the people that have to go into the factories, but people can work from home as well.
Interesting. And as we also know that you're tracking the Biden administration's attempt to shift gasoline policy to favor ethanol. Tell us more about that.
Yeah, so the Biden administration, according to Reuters, is expected to approve this week the use of 15% ethanol in gasoline, and that would take effect in the summer of 2024 in certain Midwest states. That's at the request of the governors there. So Iowa, Nebraska, and Illinois would be asking the EPA to lift the summer ban on the E15, what's called the E15. So right now, you've got ethanol that's about 10% in gasoline, so they want it to be at 15%. This would be a big win for the corn industry because ethanol comes from corn. So a big win for the ethanol industry and not so much of a win for the oil refining industry because they have balked at this idea of increasing ethanol.
Well, it's not easy to do, is my understanding.
Exactly. It's not
tough to mix it together.
It is tough to mix together. It is costly.
Yeah. All right. Well, we'll see what ends up happening. Thanks, Ines. Appreciate it. Coming up, we're going to take a look at what to watch for throughout the rest of the day ahead of the 11 a.m. hour. Stay with us.
The talk has gone from hard landing to soft landing to now we're in this discussion about a no landing, which to me, I guess I'm just on a plane forever.
No landing is basically to take off on the metaphor about an airplane, and it just means that the economy's not going to slow down. If it continues to grow, the Fed has no reason to cut rates.
A hard landing, what is it? Well, this is where a recession takes place, where the Fed tightens so much that it creates a recession. A soft landing, this is where inflation is tamed, it is coming down, but perhaps not as many people need to lose their jobs as expected. A no landing is where the economy continues to grow, but inflation is not tamed the way the Fed wants it to be.
No landing is the new buzz phrase.
Do you see a no landing scenario playing out in the economy?
It's a great expression that we've coined recently. Here is what I think the problem is with that. Inflation that stays elevated, it's problematic and unacceptable for the Fed. Higher inflation for longer is not necessarily consistent with a no landing.
What does that mean economically speaking?
If you're talking about what it means to the average person, it's a good thing because that means we're not going to get the recession that everyone's been scared about. The economy is more resilient, and that means that we've got more room to grow going forward.
There's plenty of technical reasons why this market's rallying, but it's really all about the less bad fundamentals.
How should investors be positioned for that type of scenario?
What a lot of advisors are saying is don't operate on your stomach, make sure you're allocated. The big thing is be diversified. We've had a home country bias and we've had way more invested in the S&P 500 than should be from a diversification standpoint.
Activist investor Elliott Management has nominated a slate of directors for Salesforce's board. This, according to CNBC. It's unclear the number of nominees, though. Reportedly, the slate of directors likely includes Jesse Cohn. That's the head of U.S. equity activism at Elliott. The nominating window for Salesforce's board closes on March 14th. Though that's not all for the cloud-based software company, as it's set to report earnings. That's after the bell today. Be sure to tune in tomorrow. Yahoo Finance's Brian Sazzi is going to talk to Mark Benioff about everything that's going on at the company. And there's a lot going on at the company because Elliott is just one of 5 activists who is examining Salesforce and putting pressure on the company.
Between the activist campaigns, between the executive churn that has taken place within Salesforce, no doubt Brian going to be asking about that, just as well as where the strength is holding up for the Salesforce business and what they're seeing within their business customers as well, who are monitoring their own cost structures.
Yes, most definitely. A quick check on the markets here. We had seen things dip into the red. Now it's looking a little bit more mixed right now. The Dow's actually in the green. Remember, we talked about the ISM figures creating some consternation in the market, but it's not so bad right now.
Yeah, we have had a Hyper Waffle Wednesday here early in the trading activity, so we'll see where that continues to continue to make its name known.
Yes, keep it right here on Yahoo Finance.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. March is barely up and running, and investors already have a lot to think about. China's factory activity jumps, U.S. manufacturing is in contraction, and two Fed speakers strike a decidedly hawkish tone. Your market outlook just ahead. And Elon Musk ready to unveil Tesla's third master plan at today's Investor Day, but reports of a revamp to the Model Y are already stealing headlines, not to mention a $5 billion investment in a Mexico plant, and we're across it. And retail realities. Kohl's and Lowe's join Walmart, Home Depot and Target in gloomy outlooks for the US consumer. We're looking ahead to a big report from Costco. But before that, we'll catch up with Abercrombie and Fitch, so make sure you check in later on this hour for that interview. All right, but first, let's take a look at how the major indices are faring 90 minutes into the trading day. Still searching for some direction here, but a mixed picture. We see the Dow there, the only one in the green, but just barely there, up about 15 points. The S&P there, down about 0.25%. Tech-heavy Nasdaq there, also down. We're seeing Walmart, Visa, and Coca-Cola dragging on the Dow, Apple, Tesla, Amazon, and Nvidia weighing on the Nasdaq. Let's also take a look at what we're seeing in the Treasury market as we get more signals that central banks around the world will keep rates higher for longer to tackle inflation. You see the 5 and the 10-year above 2% there in gains today. And especially as we take a look at that 10-year, it did touch, as we're seeing, that 4% threshold. Now, the 10-year hasn't sustained that level in over a decade, but as we can see, it has been oscillating a bit, but an important benchmark to watch indeed. All right, let's take a closer look at the markets as we approach the halfway point of the first trading day in March. Now, early hopes that investors could shake off a downer February have been tempered by some hawkish Fed comments. This as investors process better than expected economic data from China. Yahoo Finance's Ines Ferre has the full picture. Ines, a full picture indeed.
Yeah, that's right, Rochelle. So let's take a look first at that China data that you were mentioning. Of course, with the COVID lockdowns gone in China, you have now their manufacturing data that has come out that has really soared, posting its biggest improvement in more than 10 years. Purchasing Managers Index rose to its highest level since April of 2012. And take a look at the Chinese ADRs that are trading right now, up a big rally when you look at those. But if you just take a look at the world market, I want to point to you the Hong Kong, the Hang Seng, up 4.2%. Also, this China data buoying some of the other markets around the world in Europe as well. Here in the U.S., a mixed picture, as you were just mentioning, because of those hawkish comments from two Fed members, one of them being a voting member on the FOMC, Neil Kashkari, Minneapolis Fed president, saying basically that he is open to the idea of a 25 basis points or 50 basis points for its next meeting in March. The FOMC will be meeting this March. So the market's really all about that FOMC meeting in March. And will it be 25 basis point rate hike? That's what the market is expecting. But these comments from Kashkari really kind of jolting the markets earlier today as we saw the averages going lower. You've got the Nasdaq Composite. It had been slightly in the green earlier. Right now, it's down about 0.4%. And then just checking out the 10-year Treasury note, that yield is at 4%. You did see the U.S. dollar index going a little bit higher earlier, and so that put pressure on stocks as well. But certainly, the Fed comments, Fed members, their comments, and what they plan to do at the next Fed meeting, that's what the market is focused on right now, Rochelle.
Indeed. Well, thank you for that update, Ines Ferre, there for us. Well, investors might be hanging on the Fed's every word for a shift back to dovishness, but our next guest says those investors might be missing the point as the economy returns to normalized above zero rates. Here with a look at the bullish and bearish sentiment in markets is Carol Schleif, Chief Investment Officer at BMO Family Office. Good to see you, Carol. So talk about what the markets are missing here, because we got very comfortable with these historically low interest rates for a very long time that it sort of warped what we consider a new normal.
It definitely warped what we considered normal, because we went a decade or more assuming that rates were going to stay at zero or less than zero, as many of the global rates were for a very long time. But historically, when you stretch it out and look at longer term averages, 2 to 3% inflation in the economy tends to be pretty normal. And it also lubricates the system. It allows employees to have raises. It allows companies some pricing power, but getting back to that 2 to 3% level is obviously very jarring, especially coming off of the unusual situation we had with the pandemic and how it changed everybody's buying habits. And now we're shifting back towards some new normal, which is actually a reversion to a very old mean.
So then as we take some of this in, we're also coming at the tail end of earnings season as well here. So what are some of the three key focuses that you think bears and bulls should really hone in on this month?
I think the difficulty is we are coming to the end of earnings season. You saw nice performance in January out of the markets, much like you saw in July and October last year when we had those early earnings report season. And it's not necessarily the earnings were overwhelmingly bullish, if you will. But so now markets are trying to figure out what to anchor to. And as you just mentioned, they'll be spending a lot of time looking at every data point between here and when the Fed meets, trying to decide, will it be 25 basis points? Will it be 50? So we'll listen to Fed commentary and all of the speakers that are out and about in the next few weeks for that. We'll look at the tail end of the retail commentary there as well, but also looking globally at, we've seen the China PMI has come out overnight and be stronger than people expected. You've got a lot of pent-up demand there. So watching economic data will be important, but also watching what happens and listening in and going back and rereading some of those quarterly reports, because there's a lot of activity going on, especially in the industrial economy here. The backlogs that are being built, the spending that's coming out are getting teed up from a lot of those, a lot of the acts that were packed, the CHIPS Act and the fiscal spending teed up for key investment in very important industries here. So you're already hearing some of that, even if you're not seeing it come through the numbers yet. And then I think just watching how markets trade, watching those short-term interest rates is important. It's the first time in a very long time you've been actually paid to sit at the short end of the yield curve and watch how these things play themselves out. There's not a big impetus. There's not the fear that we had a couple of years ago, even, that there is no alternative. You have to participate. You have to buy every pullback.
So then with that in mind, what are some of the questions that your clients have and how are they putting their money to work?
I think clients are spending a lot of time looking not only at the micro issues, but at the macro issues. They're thinking a lot more too about geopolitical risk and about the tensions in Congress on both sides, but more macro, they're thinking about the tensions between the US and China and what's going on in the EU. They're watching globally much more so even than before. But I think staying diversified is very important as well, being cautious. We do presume, and our base case expectation is that we'll see more normalized returns out of both stocks and bonds this year. You had a nice January. This pullback that we've seen in here means that having diversification across a variety of asset classes, but being willing to sit on a little bit more cash sometimes. A lot of our investors are willing to sit at that short end, build out some treasury ladders, look at some structured notes and structured assets that we can put together for them. And so there's a lot of just watching and waiting and not getting too bold about any one potential scenario playing out one way or the other, but being able to keep options open is really important to a lot of our clients.
And it's interesting because you mentioned some of these global issues that are clearly outside of the Fed's control. But with every data point that comes out, we do see the markets react, even as we saw mortgage demand falling to a 28-year low, as these mortgage rates climbing up with every rate hike. Still have a tight labor market, still a lot of companies trying to get a handle on the consumer as well, as they're still spending, albeit more discerningly. What does this mean for the Fed's path forward?
I think it makes the Fed's path tricky. But also it's important to remember, and Chairman Powell even alluded to this a couple of weeks ago when he was speaking to the Washington, D.C. Economic Club, and where he talked about it's not like we have 10 prior pandemics to look at how to model this current scenario against. So I think watching and waiting for what the Fed is going to do, it makes their job tricky. But then again, the strength in the economy and the fact that inflation is coming down, it's not coming down as fast as everyone would like, but it is coming down to a certain degree. And the fact that the employment market stays so solid gives the Fed some wiggle room, if you will, to continue doing that. And the Fed has been very clear about communicating they intended to be higher for longer, because their number one goal right now of their two mandates, the number one goal is to get that price stability in the system. So they're not going to let off on that issue until they definitely see a string of economic numbers that show much more muted inflation.
Certainly a lot for the bulls and the bears to sink their teeth into. I like that picture behind you as well, signifying the bulls and bears. Carol Schleif, their Chief Investment Officer at BMO Family Office. Thank you so much. All right, coming up, Elon Musk ready to unveil Tesla's third master plan at today's Investor Day. But reports of a revamp to the Model Y are already stealing the headlines, not to mention that $5 billion investment in a plant in Mexico. We're across it all next. Tesla's Investor Day kicks off this morning, but if you're a little lost when it comes to the latest technical terms from the automaker, we've got you covered. Our Brad Smith joins us now with a breakdown. Hey, Brad.
Hey, thanks so much. Appreciate it, Rochelle. Well, yeah, taking a look at Tesla shares here, year to date, up 62%, but all eyes are on this roadmap. As Tesla announces its roadmap for the future, here's a ludicrous mode view of some of the key words. First, let's start with FSD. Let's get the first flashy term out of the way. Full self-driving is what FSD is. The company said during its Q4 2022 earnings call, with respect to autopilot, as of now, they deployed full self-driving beta to, for city streets, roughly 400,000 customers in North America. Now, this they marked as a huge milestone for autonomy, as full self-driving beta is the only way any consumer can actually test the latest AI-powered autonomy. So it's currently at about 100 million miles of FSD outside of highways, they mentioned as well. And some of their data that they've published shows that there's improvement in some of the safety statistics there. And one thing that is clear, they probably would not have released that FSD beta if safety statistics were not excellent. So that is something that the company continues to talk about, but it comes with a price tag. And a lot of customers out there are going to be keeping close tabs on when that price tag may start to abate. But $15,000 continues to be that ballpark that a lot of the analysts out there are basically baking in there. All right, so that's FSD. Now we got to talk about 4680, all right? This is the battery. The battery competition is booming right now, and arguably the biggest selling factor in the EV adoption cycle as consumers evaluate vehicle options on criteria including the best charge and the range. Tesla's 4680 name, that battery name, is a nod to the 46 millimeter diameter and an 80 millimeter height. It is 5x the 2170 battery cell. That was the byproduct of Tesla and Panasonic's venture. And 4680 cells, they reached 1,000 cars a week at the end of last year. They're also increasing that capacity for 4680 cells by another 100 gigawatt hours, as announced at Giga Nevada, I should say. And the company has also received some praise from analysts for slashing the costs to produce this battery. But one of the costs to keep an eye on is lithium. CFO Zach Kirkhorn has said of this, they're not fully exposed to lithium prices, but they think in general, as what we've seen from their forecast, their cost per lithium per car in 2023 going to be higher than in 2022. So that's still a headwind that would have to be overcome to return back to those levels. They're also going to be investing $3.6 billion more to continue growing Giga Nevada, adding 3,000 new team members and 2 new factories as well here. And so just moving right along here, as you're taking a look at some of those terminologies and the glossary terms on your screen, I'm going to jump ahead here and we're going to go to hardware. Let's get to hardware because this is important, and particularly hardware 3, 4, 5. Now, this is what a lot of people are going to be listening for as it relates to the Cybertruck. Cybertruck is going to have hardware 4, Elon Musk has said. And to be clear, for 2023, it's not going to be a significant contributor to the bottom line, Elon Musk has also noted as well there. So that is one thing to pay close attention to. But hardware 3, currently exceeding some of the safety averages for the average human, as Elon Musk has talked about as well. And then just zooming right along here, let's talk about the dojo. Now, this is where things really get interesting. And if you hear anything about the dojo, do not be concerned. This is what the supercomputer of the future could look like for Tesla. As they define it, the dojo essentially is this supercomputer built from the ground up, AI machine learning baked in, and video training. It also uses the video data coming in from its fleet of vehicles. And so they're going to be using this potentially even offered as a service in the future as well. And more specifically, to auto-label videos when they ingest all of that data as well into their neural nets for self-driving system. And then just lastly here, as we hustle to the finish, I just love looking at Optimus sometimes, quite frankly. And we'll see if we get any more information about this humanoid robot, Optimus. Friendly little fella, 5'7", 5'8". Rochelle?
Well, there you have it. Thinking of master plan with our very own Brad Smith. Thank you for that breakdown. Well, Tesla is readying a revamp of its top-selling Model Y. That's according to Reuters reports. Codenamed Juniper, the reboot could give the group a leg up in the increasingly competitive EV space. I'm joined now by Yahoo Finance's Pras Subramanian with a breakdown. Pras, what can we expect?
Yeah, I'm not surprised to hear that the Model Y refresh is in the works. The car is around 3 years old. So Tesla here going to implement some physical features, some new interior components to refresh the model. We also heard that the Model 3 late last year was also in the middle of refresh. So, Tesla under pressure here of a new competition, cheaper competition in China to make these older models a bit more exciting. So, adding these interior components, possible exterior components, and for the Model 3 potentially new powertrain features. So it's needed for the company to sort of compete here as we the EV competition both here and abroad really heats up.
And so, Pras, then, obviously a lot of us would like to see some new models, but we're sort of tempering our expectations. But can we also expect Tesla to confirm plans for a new assembly plant in Mexico today?
Yeah, this is sort of the worst kept secret right now is Tesla's next plant, and numerous Mexican government officials have been talking about Tesla coming to the country. In fact, the president said, quote, "The Tesla company is coming." So they're apparently going to build this factory in Monterrey, which is an industrial area in the northern part of the country where a lot of other auto factories are. They've apparently resolved a water issue that was the main problem. Tesla says they'll use recycled water as a way to assuage any sort of doubts or concerns about the water usage up there. And we're probably going to hear more of these plant announcements coming, because if Tesla is supposedly wants to make 20 million cars by 2030, which would make it easily the world's largest automaker, they're going to need a bunch of new plants. And I think we'll probably hear more about that Mexican announcement later today at Tesla's Investor Day.
And as you mentioned there, we have been hearing about this for a while, so it'll be interesting if we get the actual confirmation today. Thanks so much, Pras Subramanian, for that update. Right, well, Novavax shares nosedived this morning after yesterday's announcement that the company was facing, quote, significant uncertainty around 2023 revenue. The drug maker reported a fourth quarter loss almost twice as wide as analysts had predicted. I'm joined now by Yahoo Finance's Angelique Kemlani for more on that.
That's right, Rochelle. So Novavax's story, of course, we've been following for some time. Really interesting, as it's one of the major players in the COVID vaccine space broadly, globally, one of the most recognized names, but it has struggled over the years. As we know, it entered the market kind of late after some manufacturing issues set it back. So that is really catching up to the company right now. On an earnings call yesterday, the new CEO, John Jacobs, said the company is going through an assessment of its pipeline as a result of all this. As you see on your screen, looking at the earnings, $357 million for the quarter, but a total of $2 billion for the year, marking a pretty historic milestone for the company. They're also looking at fulfilling orders totaling about 2 billion advanced purchase orders for the coming year, and looking towards the fall or later half of this year to really see what the revenue looks like for 2023. That's what resulted in a concerning note that they sent as part of the earnings statement, cautioning that they're not giving a 2023 outlook and that there's some uncertainty on the line. They said, quote, while our cash flow forecast estimates they will have sufficient capital available to fund operations, this forecast is subject to significant uncertainty, and that includes government contracts as well as ongoing arbitration with Gavi. They do have about 1.3 billion on hand right now in cash, so that is a significant number to look at. Meanwhile, going forward, they do have an order of 1.5 million doses from the government, looking at the commercial market, like I mentioned, for the rest of the year. And they're also looking to reduce spend, especially in R&D and the like, that goes to assessing the pipeline. They are also looking to strengthen their internal infrastructure, looking at a facility specifically in the Czech Republic as a way to expand manufacturing. So total, that's what's going on right now. Now, I know it was kind of a grim outlook for the company. They have been struggling, in this COVID race so far. I just want to throw back to an interview, the final interview with former CEO Stan Erck at JP Morgan Health. And what he kind of explained was the state of the company back in 2019 prior to the pandemic. Take a listen.
And we had fewer than 100 people. We had less than $100 million. We had enough money to get through the next 5 months, and we were focused on flu.
So as you can hear, just a lot more, a much better position than then, but still taking a look at the pipeline once again. Back to you.
And shifting gears now, because big news this morning out from Eli Lilly. They've announced a series of price cuts that would lower insulin costs. What do we know about that?
That's right. So two of its top-selling fast-acting insulins, and this is a really complex area where there are multiple types of products. So two of their top products, they're reducing the cost by 70% starting in Q4 of this year. That includes Humalog, which is now currently $530 per 5-pack of injectables, and then Humulin, which is now $274 per vial. They are also reducing the cost of their unbranded insulin to about $25 per vial, and a new insulin that's coming on the market that is a competitor to Sanofi's Lantus will be $92 per pack, and that is a 78% price reduction from Sanofi's price. They also have introduced in the past couple of years different savings programs, including a card that would cap out of pocket at $35 per month. That is now going to be automatically in place at the counter for those who are insured, and uninsured individuals will still have to prove that, carry that card in order to get that in place. So a lot of movement. Of course, we know there's pressure on the industry. Other players like Novo Nordisk also waiting to see what moves they'll be making as a result. But all these companies have had these sort of saving programs over the years. It's just been more of like an opt-in or something that you have to know about to get into. So Eli Lilly taking the first step to make it broadly applicable and really respond to the pressure that the industry is facing right now from the government.
Definitely a more proactive response. As you mentioned, for some of these discounts, you don't even know that they're available unless you ask for them. So hopefully a lot of relief on the way for a lot of people who need their insulin. Great stuff there. Angelique Kemlani, thanks so much. All right, coming up, flying high on the CHIPS Act. We chat with a made-in-US drone manufacturer about the new legislation.
Warren Buffett's annual shareholder letter is out. Here are 3 top takeaways from the Yahoo Finance team. First up, a call to action to all humans: start saving money. Buffett says this: "It is those dedicated savers that are forefront in my mind as I write this letter." He adds, "Charlie and I are not stock pickers, we are business pickers, telling people to save money." And maybe they're listening. The U.S. savings rate is now at a 1-year high at about 4.7%. I think Buffett wants to see it even higher. Takeaway number 2, investing school is in no session. Again, no surprise here in the Warren Buffett annual shareholder letter. Buffett noting this, saying, quote, "The lesson for investors: the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. And yes, it helps to start early and live into your 90s as well." Warren Buffett, 92 years old. His longtime partner, Charlie Munger, 99 years old. Warren Buffett saying, if you want to be a successful investor, invest for the long term. No surprise, that's typical Warren Buffett being Warren Buffett. Takeaway number 3 here, a message or messages to all politicians here. Warren Buffett taking some jabs at folks in DC, noting this: Berkshire also offers some modest protection from runaway inflation, but this attribute is far from perfect. Huge and entrenched fiscal deficits have consequences. Interesting take there from Buffett. Buffett also says, really tries to, I think, champion stock repurchases, saying repurchases, those that tell people that repurchases are harmful to shareholders or to the country are particularly beneficial to CEOs. You're listening to either an economic illiterate or a silver-tongued demagogue. So Warren Buffett taking some swings at politicians. What we did not hear in this letter, no succession plan. Warren Buffett and Charlie Munger will be at that May 5th to May 6th annual shareholder meeting in Omaha. Brian Sazi out.
The best semiconductors in the world right now are made in Taiwan, very close to China, supply chain on the other side of an ocean. We rely on these chips for pretty much everything, anything that has an on-off switch, but more importantly than that, sophisticated weapons and weapon systems. I spent 25 years in the United States Navy, flying airplanes off of an aircraft carrier as a test pilot. We need those chips. Well, now, because of this legislation, they're going to be made here in the United States of America.
Well, that was Senator Mark Kelly of Arizona there discussing the CHIPS Act, the Commerce Department now accepting applications for funding from corporate America. Now, following the news closely, hardware makers like US drone manufacturer Skydio, the company makes drones for civilian, emergency services, and for the US military. For more, let's turn now to Adam Bree, Skydio co-founder and CEO. Good to have you on the show, Adam. So obviously, we've heard a lot about the CHIPS Act. Good to have you. So we've heard a lot about the CHIPS Act funding, but obviously it affects different chip companies in different ways, or those who are further down in the supply chain. How does that affect your business?
So I think that we're part of a broader trend. I mean, I think people have realized that it's just untenable to be dependent on technology that's ultimately beholden to Chinese government policy. So drones came onto the scene 3 or 4 years ago and sort of seemed like consumer toys, but it really emerged as critical tools for all kinds of national security applications. So we use chips in our drones made by NVIDIA and Qualcomm, 2 US companies. Both of those are directly impacted and benefiting from the CHIPS Act.
And of course, you mentioned China, and when we think of some of the supply chain disruptions that are still working their way through the system, we know that this was a real wake-up call for a lot of companies, some choosing to diversify away from China, others trying to sort of build up in-house. In terms of any sort of changes for your suppliers for chips, any sort of considerations that you've made since then?
So I think we've been kind of counter trend from the beginning. We started in 2014, and we've always done our manufacturing close to home. Our original product, R1, was manufactured in our headquarters in Redwood City. With the new funding we're announcing, we're opening a large facility in the East Bay in the San Francisco Bay Area. So we've always built our drones close to home, and we did that because we felt like it was the best way for us to deliver a high quality product really quickly. It's become really strategically important. Building drones in the US for the customers that we're serving is critical for data security, cybersecurity, national security. So it's kind of come on trend, but it's something that we've actually been doing for a very long time.
So I want to talk about this funding, $230 million there, giving you a $2.2 billion valuation. Some heavy hitters in there, Andreessen Horowitz, Docomo, NVIDIA, the Walton Family Foundation, as well as Axon. Talk about that, getting to this investment threshold, as well as what that means for your expansion plans.
So, I think it's a real milestone for the U.S. drone industry. 5 or 6 years ago, people wrote off the industry. They thought this was a market that was going to be dominated by foreign companies. And we never believed that to be the case. We always felt like the industry was still early. And if you could make drones smart enough to fly themselves, it was really a step change in who could use them. So we're really excited today to have customers across a wide range of industries. We've got over half the state departments of transportation. We've got the U.S. military. We've got a number of energy utilities. And the benefits that drones can provide are enormous, but if you make them smart enough to fly themselves, they can be deployed much more easily and widely across organizations. So the investment that we're announcing today is really the progress that we're seeing, and it's reflective of the progress we're seeing in the industry, progress we're seeing with our customers. And I think it's an exciting milestone for the US industry.
And it really has been an evolution. I know that in the beginning, you were mostly known for your consumer drones. People like to take a drone selfie. But I mean, you also donated drones to the Ukraine military to help during the invasion, I know at the beginning there. Talk about that decision and what that visibility really meant for some of this sort of defense-related spending and investment when it comes to drones.
So there's this really interesting trend that's been building over the last few years where the military is some of the original users of drones. They've been using drones for multiple decades. But what's happened over the last few years is the civilian technology has really outpaced a lot of the traditional defense systems. So, the consumer drone that we're making for a few $1,000s has better capability in many respects than a defense system that costs hundreds of thousands of dollars. And to the credit of a lot of folks in the US Army and other branches, I think they realized this and sort of leaned into it, which is responsible for a lot of our US government business. And we've seen that trend really crystallize in Ukraine, where civilian drones have become strategically critical. So we donated hundreds of thousands of dollars worth of systems at the beginning. We've since deployed hundreds of drones in Ukraine, and we're really seeing on the front lines there the impact that this technology can have.
And of course, have to ask you about the competition. You have Chinese-owned drone maker DJI. Now, they're not allowed to be used by US agencies, but obviously they're a much bigger company, can price their products more competitively. Talk about the edge, though, that you think Skydio has in this space.
Yeah, so we have the great joy of being the US underdog, which doesn't always happen. So we're the leading US company, but you're right, we're still small relative to DJI. So for us, the biggest thing is thinking about where's this market going? Where's the industry going? And if you think about the early days of the PC industry, it used to be that you had to be an expert programmer to use a computer. Everything happened at the command prompt, and people did a lot of useful stuff, but computers were used for just a small slice of what they're used for today. And so our big bet is that if you make the thing smart, if you make it software defined, you can turn these things into ubiquitous tools. And that's really what we're focused on. So the market as it's defined today is predominantly manually flown. We think the future is AI, autonomy, drones become basic infrastructure. And that's what we're most focused on. So, customers buy our products because they're more secure, they're more trustworthy. But most of our customers are really betting on the future and where this is going with AI and automation.
And certainly exciting stuff when you think of AI then being incorporated more and more into drones. We'll be watching this space. Adam Breather, Skydio co-founder and CEO, thank you for joining me this morning. Right, well, on a programming note, cloud-based software giant Salesforce is set to report earnings after the bell today. So be sure to tune in tomorrow as Yahoo Finance will get the chance to sit down and speak with Salesforce CEO Mark Benioff. You don't want to miss that. Right up next, retail realities. Kohl's and Lowe's join Walmart, Home Depot, and Target in gloomy outlooks for the US consumer. Next, we'll catch up with Abercrombie & Fitch.
Activists are circling Salesforce in a situation that's growing increasingly high stakes for CEO Mark Benioff. Right now, Salesforce is facing down 5 activists, all of whom are demanding better expense management from the cloud giant. Here are the 5 activists. 1, we have Third Point, led by billionaire Dan Loeb. He's previously picked a number of high-profile fights, including at Disney and Shell, and Loeb's the latest to join the Salesforce activist fray, revealing his stake back in February. 2 and 3, Value Act and Inclusive Capital. It's worth talking about the two in tandem because they have something in common. Jeff Ubben, who's the founder of both, and they've already notched a win. Mason Morfitt, Value Act CEO currently, and Jeff Ubben's handpicked successor, was already named to a seat on Salesforce's board in January. 4th, there's Starboard Value, which got involved in Salesforce back in October. A source tells Yahoo Finance that Jeff Smith's Starboard is disappointed in the cloud giant's cost management, but isn't pushing for Salesforce to divest any of its mega deals, for example Slack, which is on the table for other activist investors. 5th, Elliott Management goes for the jugular. The firm, fronted by Jesse Cohn and Paul Singer, often seeks board representation and even has a private equity unit that is known to bid on targeted companies. Sources tell Yahoo Finance that Elliott's stake is worth billions and that they're going to be pushing for succession planning from Salesforce CEO Benioff and better profit margins. So, where does that leave Salesforce investors right now? We asked Wells Fargo analyst Michael Turin.
I think right now, a lot of things are pointing in a favorable direction for investors around where Salesforce ends up over the next 12 months. The longer question is the harder one to answer on what is the 5-year vision.
Salesforce is reporting earnings Wednesday, so this standoff is heating up.
Well, today we got more insight into the state of the consumer with Kohl's and Lowe's earnings before the bell. As you can see there, the shares moving to the downside there. Kohl's off by almost 4% there, Lowe's down almost 6%. Well, Lowe's, like its rival Home Depot, missed on revenue expectations as the housing market downturn continues to weigh on home improvement retailers. Both saw a decrease in same-store sales for their fiscal fourth quarter, though Lowe's was the larger dip. And Kohl's, the retailer currently feeling the pressure from activist investors, also had a tough time with shoppers, reporting a big loss and a sales decline of 7% in the fourth quarter. Now, also setting a weak outlook for full year 2023, anticipating net sales to decline between 2 and 4%. A tough picture there. And of course, tomorrow, we get to hear what Costco is seeing from consumers. Here with a preview of what's to come is Yahoo Finance's very own Brooke De Palma. Hey, Brooke.
Good morning, Rochelle. That's right. The consumer spending power is really in question here as we look to Costco after the bell tomorrow, their fiscal second quarter results, as consumers really look to seek value and their spending power is perhaps challenged in this inflationary environment. But taking a larger picture here, if you take a look at what analysts expect on the street, revenue is expected to see $55.58 billion. Adjusted earnings per share expected to be $3.20. Now, same-store sales expected to get a boost here. Once again, consumers looking to get more bang for their buck, looking to get more value. So sales overall expected to be 6%. Now, international sales expecting to boost that number. International alone is expected to see a 7.10% increase. Here in the U.S., up more than 5%. Now, if we take a deeper dive into exactly what Wall Street is keeping a closer eye on and looking for in these quarterly results is really a consumer spending shift. As you were noting before, Kohl's, Lowe's seeing consumer spending shifts, but we saw this largely in Target and Walmart's earnings. We saw that consumers are skipping over those discretionary items like electronics, apparel, and things of that nature and shifting to more food, fresh, and miscellaneous items like maybe that, a quick grab of a chapstick on their way out of the store. In addition to that, perhaps consumers shifting to private labels on their way out, saying, okay, I have a few dollars left. Doesn't make sense for me to get that private label that's perhaps $1 cheaper. Also in focus is that potential membership increase. We see Costco tend to increase their membership fees every 5.5 years. That would bring us to January of 2023.
So then you have to wonder then, as consumers are trying to figure out where to cut costs then, how does Costco's current membership fee compare to others?
Yeah, well, when you take a look at all of the wholesale retailers, of course, all of them hoping to bring in more consumers here as more of them seek value. You know, Costco tends to be on the higher end of things. As you can see right here, it's $60 for a Gold Star membership, $120 for their executive membership. That's more than Sam's Club and BJ's. It's important to note here that Sam's Club did increase their membership fees back in August, up from $45 to $50 and $105 to $110. But important to note here as well that Costco does hold more than half of the market share when it comes to wholesale retailers here. So really perhaps setting a precedent for what exactly it expects of its consumers. Of course, it is an international operation, whereas Sam's Club and BJ's is mostly here in the U.S. But ultimately, at the end of the day, Wall Street's pretty optimistic that customers are going to Costco for more bang for their buck in this inflationary environment.
And we'll have to see if that customer loyalty sticks. Great stuff there, Brooke De Palma. Thank you so much. Right, well, for more on the state of retail, our very own Brian Sozzi is here. Brian, take it away.
Hey, Rochelle. Yes, Abercrombie's out with its latest earnings. The company beat on revenue but missed on profits. Let's get right to it with Abercrombie & Fitch CEO Fran Horowitz. Fran, always nice to get some time with you. Earnings call done. You heard a little bit of our setup here, a more cautious consumer. What are you seeing from shoppers when they cross that lease line at Hollister and Abercrombie?
Hey, Brian, good to be here with you. So we were pleased with our fourth quarter results. On a top line, finishing up 5% on a constant currency basis was a strong ending to the year. You know, our A&F business continues to be strong. We made a lot of progress on Hollister last year. So what the consumer is telling us is that they have a choice on where to shop, and they were choosing us for the fourth quarter. We're going to stay focused on our product, our voice, and experience for 23 and get them to continue to shop with us.
How focused are you right now in an environment with so much uncertainty on promotions, maybe offering some more opening price points to shoppers?
So fourth quarter is always the most promotional time of the year. We head into each quarter, ready to compete, but we really focus our promotions on our own product. We don't concern ourselves what others are doing. We meet with the teams, on a weekly basis and make sure that what's working, what's not working, we're addressing very currently.
Talk to us about the individual brands, Abercrombie and Hollister. There was sequential progress at Hollister, but the Abercrombie business continues to be on fire. Why is that the disparity between the two brands?
Yes. So the Abercrombie the Abercrombie brand itself, Brian, had a fantastic year. We're so excited about that brand turnaround. You've been on this journey with me for a long time, and it's been awesome to see this consumer responding. He and she did not seem to feel as pressured by the inflation as the Hollister consumer did. About midway through last year, that consumer, the Hollister consumer, who's in a different demographic than the Abercrombie consumer, had a lot more competition for the wallet. These teens and their parents, had felt the inflation impacts a bit more. But again, as we dug in and found some that we owned some of that, and we got our assortments, better aligned for fourth quarter and got into those cargos and those dresses that they were looking for, we saw sequential improvement.
What is working right now in the Abercrombie brand in terms of style? I go to the site, Fran, and it takes me back to when I was in high school.
Well, what's so awesome, right, is the brand has just diversified beyond jeans and T-shirts. We are serving so many wearing occasions for our consumer. They love their 96 hours. I talk about that quite a bit, and everything that they're doing on those weekends away with their friends, whether that's for weddings, bachelorette parties, showers. So from a special occasion perspective, we're there for them. Now they're coming to us for back to work. So now a lot of the offices are opening up again. We are doing incredibly well with our bottoms business. In fact, we had our best year ever in pants. She is wearing pants to the office, and then she's wearing them out on date night.
Well, you're a merchant in heart, Fran. What is the new wear to work attire for men and women?
It's much more casual than it used to be, but you still have to look sophisticated and put together. We have an amazing pant called the Sloan pant that has just taken off. People are named. We named and claimed it, as you know. And on TikTok, you can see everybody talking about it. So she's wearing a nice pair of, I'll call them dress pants, trousers with a bodysuit and a jacket over to her cardigan. And they're also wearing jeans. So depending upon where you're working and what you're doing, we can outfit you for it.
You mentioned TikTok, and you and I have talked about this in the past, how far that Abercrombie brand has come on TikTok. Is it translating to sales? And then what's your strategy there this year?
Oh, absolutely. Listen, our customer is completely digital, whether that's Hollister or Abercrombie, and they are learning about their product from their friends. Today, our customers trust their friends more than they trust a company themselves, right? So they're seeing something called user-generated content, and the customer gets on there and talks about their hauls, talks about what they're wearing, what they're enjoying, and TikTok continues to be an avenue for them. But it's all digital channels, Brian, that are also supporting that, whether it's Instagram, Facebook Reels, all of them are working for our consumer.
Fran, I barely know how to use some of this stuff. I just figured I'm still figuring out TikTok. I never wanted to be that old guy, but I guess here I am. But I'm back on Hollister, the sequential improvement. Yes. How do you go upon continuing that in the first quarter, spring break season coming up, with a shopper, to your point, that is more lower income and is concerned about their budget?
Yeah, so that consumer obviously has to make some tough choices, but the most important thing is that the team has done so much hard work. When we left the second quarter, disappointed with our results, we dug in and we really got much closer to our customer. So for example, denim. Denim is an important category to us, but he and she were telling us they wanted cargo pants or they wanted dresses. We didn't have enough of those for the second quarter to offset the business. And as we headed into the fourth quarter, we chased it. We went after them pretty aggressively and made sure that we were in stock and what they were looking for. So as we head into spring break, same applies, much closer to the customer that we've been. What's great, Brian, is that chase is back in our vocabulary for Hollister. That was one of the toughest things for the teen market last year with the supply chain, was not being able to read and react to your business as much as we're normally used to doing.
Do you see any of the inflationary costs that you've been battling the past year and a half, cotton costs, freight costs, is any of that starting to ease?
Yeah, the freight costs for sure. That's a much more immediate push that we're seeing. We're feeling those effects immediately. Cotton is a little bit different. Cotton is a much more longer lead time. So our expectation is to see some of those costs abate in the back half.
There's something different about the Abercrombie brand, Fran. I think it speaks to the heart of you trying to reboot or reinvent the culture at the company. I see it on TikTok. I see it on the homepage. Talk to investors about the efforts you have been undertaking there to change the perception of this brand, and what else are you working on?
Oh, Brian, you're tugging at my heartstrings. I'm incredibly proud of the work that the team has been able to do to make us a much more inclusive and diverse company than we ever were in the past. That goes from sizing that we're doing, including, smaller sizes, larger sizes, and whole inclusivity opportunity in sizing, as well as a diversity in our associates. The work is endless. All of our impact partners that we're working with have helped us also understand our consumer. If you look at something like an Abercrombie brand, we're going to launch a collection that's an always on, it's not just Black History Month for 1 month, but it's actually Black History all year long. And we're going to launch an always on collection for that. So I could go on and on and on. There's lots of things, lots of exciting things happening. And as the year comes on, we'll continue to share those with you.
Really good initiatives there. Fran, Abercrombie & Fitch CEO Fran Horowitz, always great to get some time. We'll talk to you soon.
Thanks, Brian. Take care.
Thanks. Rochelle, back to you.
All right, great stuff. Thank you, Brian. All right, well, coming up, we'll tell you the number one thing women are worried about when it comes to retiring. Stay tuned. Women were hit hard by the pandemic, and now with recession concerns and sticky inflation, women close to retirement are worried about where they stand. 62% saying they expect to retire later than they originally planned. Well, joining us now with how women can protect themselves in retirement is Suzanne Norman, Alliance for Lifetime Income Education Fellow. Thank you for joining me this morning, Suzanne. So as we look at this picture here, even as we think about how inflation is affecting women, 57% postponing retirement because of inflation. Talk about the position that is unique to women as we sort of try and navigate this space.
Thanks so much, Rochelle. It's great to be here, and it's my favorite topic. One of the things that I like to level set for everybody, just because not everyone is aware of some of the challenges women face, but it's something that is on my mind all the time, which is we have much longer life expectancy than men. A 65-year-old woman can expect to live to age 87, which is a few years longer than men. And that, again, is an average. The other thing is we haven't necessarily earned as much money. We have a wage gap compared to men, and that's an average as well that gets worse depending on what sector you're in. If you're a Latina, a Black woman, a mother, it's even less than that 82%. And then that impacts our savings because we're also out of the workforce taking care of our parents, of our children. So we have less retirement savings. And our healthcare gets more expensive in retirement because we are living longer. So these are things that are on my mind. When I think about helping women, particularly in light of what we saw last year in the markets, it's really, I guess, first and foremost, have a plan, have a financial plan and get it in writing and update it. Things change, you get divorced, you take care of your parents, you're taking care of children, sometimes all at the same time. So have that written plan so that you know what's going on. And foundational to that is a budget. So knowing what your inflow and outflow is really critical no matter where you are, but particularly if you're a woman planning for retirement, knowing what your needs are, your wants, those necessities, and then making sure that those essential expenses are covered. And one of the things we'll talk about today, I'm sure, are the role that annuities play in covering those essential expenses in retirement.
So let's first start by sort of setting the stage when it comes to a financial plan. You mentioned a budget. What are, say, 2 or 3 other things that you really need to have in a financial plan to get an actual idea of what you're working with and the risks you could perhaps be preparing for?
Thanks, Rochelle. I think the most important thing is what people are doing today. So if you're an investor, if you're an advisor, you're dialing in and you're educating yourself. So knowing what you need in your life, what your goals are, is really critical when you start thinking about what this financial plan looks like. Another thing that I mentioned, it's that time of year we saw that the ability to defer more savings. If you're contributing to a 401k, if you're over 50 as a woman, you can now contribute up to $30,000. And the other thing that I think about when you go into budgets is annuities are also a great tax-deferred savings vehicle for a woman, especially if you're trying to catch up for retirement savings.
So as you talk about annuities there, and perhaps what people should be asking their financial advisors about this, what are some of the top things that women should keep in mind when it comes to annuities versus, say, other investments that they could be making?
Thanks, Rochelle. That's probably the number one question I get all the time. And one of the things that we've seen with record sales in annuities last year, more than we've ever seen, is that they're giving peace of mind to the investor. We saw a lot of volatility in the market, which is concerning for everybody. And the peace of mind that we're seeing, having that secured income, that guaranteed income in retirement, can't be overstated. When we think about the trends that are in the retirement space right now, traditionally, retirement was coming from 3 sources. We call it the 3-legged stool. You had pensions, Social Security, and income from personal savings. Well, right now, we look at pensions, only about 4% of companies are offering them. So very few investors have access. So when we think about what the annuities role is and essentially giving you a personal pension, it's no surprise that that's given people a sense of stability and having that stool more stable. And people ask all the time, what annuities am I seeing? Well, we see the most popular ones out there, fixed annuities, variable annuities, fixed index annuities. But I always come back to that plan and the fact that if you're working with an advisor, they know your personal situation. So they'll know the right tool, the right annuity to accomplish your retirement goals.
And of course, a lot of people having one eye on what's happening with Washington and discussions over Social Security. And in 2024, the US is going to have more people over the age of 65 than at any other time in US history. What should people keep in mind about Social Security so that they can perhaps be a bit nimble if there are any changes that they need to be bracing for?
That's a great point, Rochelle, and thank you, because we talk about that 2024 as being peak 65. For those of you who haven't visited our protectedincome.org website, we have a lot of research there, and certainly we have a lot of academic research, a lot of academic, as we call it, talking about Social Security. So I would certainly, as an educator, always tell people, please get a login for Social Security, so know what that looks like. Most people are considering that Social Security won't be enough for them to have the lifestyle that they want. So again, that's where we're seeing annuities having that ability to protect and grow your retirement savings to augment Social Security. So I would certainly encourage people to visit our website for a lot of the education resources, and also have a plan that may be helping you through annuities have extra income to meet your essential expenses.
And just very quickly, as we're almost out of time here, in terms of changing the company culture of some of these corporations that already do put women on the back foot when it comes to having this wealth gap, what would your top recommendation be if you could get the ear of corporate America?
Well, if I could get the ear of corporate America, I would definitely say get that education, have the plan, make that part of the conversation that you have inside the company. And certainly, you know, it's Women's History Month. Happy Women's History Month, by the way. And we have an opportunity as women to really take control and take a look and talk to our advisors about what our futures look like and what that guaranteed income source will be to meet the essential expenses. And if you're an advisor listening, I would say to you again, clients and investors are asking for these solutions. So yes, Rochelle, the companies are a great place to start. There's a lot of education and wellness happening. In fact, I wrote a paper on that, which is on protectedincome.org. So I definitely have companies take a look at that. And I'd encourage advisors to really talk to their female clients about what their concerns are about meeting essential expenses.
Lots of great advice there. I do appreciate you joining me this morning. Suzanne Norman, Alliance for Lifetime Income Education Fellow. Thank you so much. All right, well, cloud-based software giant Salesforce is set to report earnings after the bell today. So be sure to tune in tomorrow, as Yahoo Finance will get the chance to sit down and speak with Salesforce CEO Mark Benioff. Before we go, let's do a final check of the markets to see how they're faring as we head into the noon hour. Still a mixed picture here. Only the Dow in positive territory, as you can see, that by about 0.25%. The S&P there just down slightly there, down about 6 points. The Nasdaq way down the most there by about 0.33%. A lot of the tech heavy hitters there, Apple, Microsoft, even Tesla, really weighing on the Nasdaq today. Well, that'll do it for now. I'm Rochelle Akufo. I'll be back at 11 a.m. Eastern. Until then, have a good one.